Today is Thursday, the 22nd of May, and at 8:30 a.m., guys, we had unemployment claims. I'm not sure if it did anything. Haven't even been looking at the markets today. Good morning, Andy and Cav and Bob. Russ, good to have you. Erla. And at 9:45, guys, 9:45, was there, Gary? Does basketball season ever end? Man, not a basketball fan, so it feels like it's always on, though. They were like, you know what, let's just play year round. Why not? Who needs a season? Got 4 seasons. It's always NBA conference finals. At least the college guys have March Madness. They keep it down to 1 month. Gary, I don't watch basketball. It hasn't been. I know it does. This is me being silly because I feel like it's always on. I feel like there's so many games. All right, guys. Today at 9:45 a.m., we're going to have two events that are high impact, both flash manufacturing, flash services, and at 10 a.m., we're going to follow it up with a medium impact and the form of existing home sales. I check news every morning. I go to forexfactory.com/calendar and I take a look. And the reason I'm doing this, I would be lying if I said that I had any emotional investment in the flash manufacturing. But what I do know is that when news prints, it can upset the patterns that I'm looking for. It can upset what I'm trying to do. So this quick check really lets me know when the market may have some sort of emotional reaction, whether it is a spike or reversal or simply just becoming too fast to trade. Um, so that is the beginning of each and every day, guys. And then as we go through the morning, we're going to do the same thing all the time. We're going to talk about a high probability trend trade this morning, but I wanted to introduce this as well. It came to my attention that there's a lot of people that don't bother going and reading the instructions. I'm typically one of them. Guys, understanding Nexgen indicators, there's a video in this document that is outstanding. And it talks through everything that you're going to see on these charts. It talks through the triggers, the areas, everything. I would encourage you, if you're a brand new user, go through and take a look at it. This is John Novak breaking down his masterpiece bit by bit and even getting a little technical on it if you need that. But what I'm going to talk about is everything here in the trading plan. We're going to talk about this high probability trend trade this morning, guys. This is a trade that when you learn three very simple rules, it teaches you to read your indicators, to recognize advantages, to understand when there is an edge present in the market, and that edge is why you get into the market. So we're going to focus on a trade that you'll be able to test, you'll be able to prove. It is repeatable. And guys, this highest probability trend trade that we teach first thing every morning, guys, this is the best of the best. This is your best chance of success as a brand new user because this is a trade that typically wins 70 to 80% of the time if you follow the rules. We're going to break them all down individually, how to study them, what to do with them, where they are. And the whole goal behind teaching you this trade first, keeping you focused on a very simple trade, is because when you learn to read your indicators, you're going to say to yourself, I have what I need to enter the market. I have an edge. I have an advantage. Or simply you're going to say, I don't have my edge. I choose not to trade. And guys, that's actually 90% of your morning. 90% of your day is spent waiting for these advantages to come into play as a brand new user. And then as soon as you can do that, as soon as you do know what you're looking at, what you're seeing, you'll begin to formulate your own plan. You're going to see a lot of that this morning. You're going to see people that look like they're breaking rules, but rather they're creating their own rules because they've learned to read their indicators. So that's going to be our goal this morning. Little reminder for you guys that are new. If you're on day one, don't worry. There's a lot of new terminology, guys. By day 3, the language begins to click, and that's where the forward progress really takes off. But in the beginning, I understand completely. It feels like you're drinking from a fire hose. That's okay. That's education. I was talking to my wife about this last night, and she's brilliant, brilliant. I don't know why she's with me, but she even said to me, she goes, yeah, she goes, of everything I've ever learned, I rarely learned it in the first day because, guys, you got to have realistic expectations. You got to learn the language, and then you got to learn how to apply it. And then you've got to create the repetition for it to become easy. And that's what we do in this room. We start with the language, and these are what we're going to talk about. These are the indicators that you'll be seeing on your chart. These are the same indicators from the video. I've been asking the same question for 31 years. Guys, the charts we use are going to have trigger lines on them. There are small triggers and there are large triggers. There are solid lines, there are dashed lines. When they're green, they're going up. And coincidentally, when the background is green, the market is in an uptrend. You're looking for rules to be met for high probability trend trades long. When they are red, their trigger lines are going down. And the same is true with the background. When the background is red, you're in a downtrend. So both charts that we use today will have trigger lines on them. They will show up in everything that we do. The only thing that you need to know is that these are small and these are large. And then both charts will have areas. I made a new high definition picture for you guys. Areas are really, they're pretty much horizontal lines that run across a chart. You're going to see divergence highs. That's that magenta line with the negative number printed on it. And these come from a high pivot. And what it does is it lets you know that there was a loss of momentum. And when the market is trending up, this can become an area of resistance. Fibonacci resistance is the solid red line. And when the market is trending up, this is an area that could stop the market, that could cause a reversal, that could set off a fight between the people in control. You're going to see a midband. And a midband is just going to run through the center of your screen, guys. When it's magenta, it may behave as resistance. When it's green, it may behave as support. You're going to see blue Fibonacci support. That's that solid blue line. This is when the market is trending down. This is an area that may stop or reverse the market. And you're also going to see yellow one-to-ones, depending on the direction of the market. If the market is trending down, these can behave as support. If the market is trending up, these can behave as resistance. And then divergence lows are just the polar opposite of divergence highs. It means that there was a loss of momentum at a low pivot. These can act as areas of support. I need to fix that. So we're going to take these indicators and we're going to break them down into 3 rules. And we're going to use these indicators to recognize 3 advantages, guys. That's the whole goal of this classroom in the first hour, is for you to recognize these advantages. And the first advantage is what we call strong triggers. And strong triggers means that we have momentum on our side, guys. And momentum is hard to stop. This is a large chart endeavor, and it's difficult to slow down a market with momentum. Terminations false, room to profit targets true. We're going to call that a clear path. As a new user, as an old user, guys, when you understand momentum and path, when you understand how to identify a market where the odds are favorable for it to continue in the direction of the trend with momentum, and then when there is nothing in the way to create a bounce or a spike or a fight, guys, this is the core, and this is what we're really going to focus on in the morning. We're going to focus on having those large chart advantages, and you're going to feel like you are in a loaded down semi, nothing in the way. It's going to be hard to stop. Your third rule is just defining your entry, getting you into the market where the market is most likely to continue with the trend. These 3 rules create 3 advantages, and the recipe for a trade is a brand new user. I'm going to encourage you. Force this to be your recipe for a trade for 20 days. And if you do, you're going to begin to see all the trades beyond. But these 3 advantages are what it takes to make a trade. These 3 advantages happen on only 2 charts. That's all it takes, guys. I'm giving you 5 things to think about to find success with this software. The large chart is a very slow-moving broad stroke of a brush. It shows the overall opinion of the market. And it takes 1 bar, and there's a yellow box around it. There is 1 bar. This is going to define direction, momentum, and areas, guys. Rules 1 and 2 must be met on this most current bar. It's not a lot to look at. Inside of this bar are where entry rules are met, guys, and that's the second chart. It's a small chart. It's a refinement chart, and it takes that very broad stroke of a brush and it shows the inner workings of that bar from the bottom of the bar to the top of the bar. There's typically a reversal, a retracement, a bounce, and continuation. We're going to use this refinement process because it's going to allow you to reduce risk. It's going to allow you to maximize your profit potential. We're using these two charts, guys, because this is my favorite metaphor. This is who you're trading with or who you're trading against, guys. The large chart is the big crowd. These are the men and women with the money and the influence to create trends. These are the same people that establish the momentum that we need through rule number one. And these are the same people that are reacting at those Fibonacci areas that could stop forward progress in the market. This is where buyers buy and sellers sell. And guys, the large crowd typically wins. So we're going to look for those advantages, those big, hard to lose advantages on the large chart, trading with the large crowd. The small chart, I want you to think of it as a group of fighters. The small chart is the small crowd. These are the men and women that love to fight the trend. These are the men and women that love to fight momentum. And they've got some pretty good backing, so they can create what we call a retracement, a little push down. When everything is greening up over here, you're going to see a flicker of red. That's the fight from the small crowd. Rule number three is designed to pinpoint exactly where their fight is most likely to fail. And the cool thing is their fight typically fails about 70 to 80% of the time, which means that if you're following the rules, if you're trading with the large chart, you're going with direction, with momentum, with a clear path, you have the potential to win up to 70 to 80% with this highest probability trade. We're going to talk about the best of the best this morning. So we're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. The easiest way to say that is it's okay to trade when my rules are met, guys. Your rules are going to describe a pattern. This pattern is repeatable, it's testable, and you can prove that this pattern wins more than it loses. And that's what we're going to do. So commitment to rules, and then you're going to be able to simulate. I encourage you to simulate. Don't wait for feeling like you've mastered it. Don't wait until you're like, oh, I better not do it for a week because what if I make a mistake? Guys, simulate, practice, make all the mistakes in the world. But the first step in becoming confident ASAP is post in the room. You see a lot of these screencast links getting posted in the room. We're going to address them all in the second hour. And inside of those links, there's no doubt in my mind, everybody's telling me what they saw and why they did what they did. So when you post in the room, you're asking for a private session, and I am happily giving you that private session. You're going to talk about the momentum that you saw. You're going to talk about the path that you had and the entry that you took, guys. And if you give me this information, not only are you telling me how you read your indicators so I can make sure that you're reading them effectively, but you're also, guys, you're creating pattern recognition. You are writing a recipe for success when the trade is a good one, when the rules are followed, and you're also writing a recipe for avoiding disaster, because if you made mistakes, you're going to get that feedback in the room, and you're going to be able to go back and study it in the morning and say, wow, this is what I want to avoid. So post in the room, guys, and don't worry whether it's right or wrong. Write those rules on the chart, write a yes or a no, and we're going to work together, and we're going to figure out exactly what you're doing well and what you could use a little help with. And that's kind of the beauty of the education, guys, is it's a no judgment. It's simply chart reading. That's what I do here. My hope is that you're making sure that you have the correct rules, that you're doing your best to embrace momentum, path, and entry. Because what happens for new users is when you get lucky breaking rules, man, I'm trading without momentum, I don't have a clear path, but I'm going to jump in with 100 lot and make $1 million, and then your brain believes that that victory is real. And then the second you go live, it's like that luck all runs out. So try not to practice the wrong trades. You will make mistakes, but don't intentionally. And then we're going to simplify. One trade, guys, for an entire hour. High probability trend trade. We're going to break down the rules individually, what they look like, how to study them, what they mean to you. I'm going to give you all the tools you need, including a trading plan, so that you can take that best of the best trade. Your job is going to be to understand what the look is. What is the pattern? What does it look like? The easiest way to do that isn't necessarily in the beginning taking trades, but rather just Looking at pictures, creating a correlation between your eyes and your brain. Your spreadsheet is going to be the easiest way to make these looks easy because the spreadsheet is designed on the idea that repetition creates recognition. And I put this spreadsheet in the room every day. I typically update it almost every day. And it has the 3 rules for the highest probability trend trade that you could ever take in green. Strong triggers, clear path, entry. This is when it's time to take a trade, guys. You're going to piece these 3 things together to create a trade. You will get to your entries faster if you try to learn these one at a time. And when you learn what it means to have strong triggers, focus on what it means to have weak triggers. Because not having your rules met is your little poke in the ribs to say, hey, this isn't my trade, and this isn't my trade. So this is designed to help you get to rules understanding and adherence a little quicker. There is the client trades where I just steal trades from you guys when they're rules met. These are high probability trend trades, the highest probability trend trade that we take. These are also a lot of pictures of a medium probability trade, and these are the second trades on the plan that I'm going to give you. Go through and study these, guys. By looking at these pictures, by reading what people wrote on them, you're going to begin to recognize these. That's how you slow the market down. Entry sequences, long and short, a little bit for the NASDAQ adrenaline junkies, and then you get into management because we're working on great entries for an entire hour. Great entries create very manageable trades. So there's a very mechanical management plan that I'm giving to you in the KISS plan that's provided. And then there's ideas and when you can change that up using your chart reading. There's a place for you to put all of your pictures to build your plan. And then the trade tracking sheet. And this is the one in my own personal life paid the highest dividends. Because every time I'd take a trade, I would go through that process that Nexgen talks about. And just a heads up, I fought it for about 6 months, which is why I'm so good at teaching it now. But I would post in the room, and I would tell John Novak, who was running the room then, I say, hey, this is what I did, and this is what I saw, and this is where I did it. And what John would do is John would, and it hurts sometimes, he would say, hey, you're trading in termination conditions. You're breaking this rule. You're fighting this. So here's how you fix it. And he didn't just beat me up. He beat me up privately because I'm a sibling. But he would say, here's where you're having a challenge, and here's exactly how to fix that challenge, guys. And if you go back to your trade tracking sheet every morning, and you look at what you did yesterday and you ask yourself what worked and what didn't work and what felt easy and what felt, what made me feel nervous. What you're going to do is you're going to begin to recognize those patterns in the market that are bringing success, that are providing failures. And then I think most importantly, the feedback from class, you're going to begin to see some patterns in yourself. Everybody has a thing, whether it is fighting termination conditions or whether it's trading against the trend or jumping in early or getting out late. Guys, this is where you're going to begin to see that and when you're going to begin to commit to missing it. Lonnie, we're going to talk about TradingView in the last hour. I'm going to keep this first hour focused very heavily on the Nexgen software education. So at 11 a.m. Central, we'll start talking about it. I don't want to confuse brand new users, people learning the software, with the TradingView stuff yet. We're going to focus on the software company side of things for 2 hours. So if you'll repost that question around 11, that would be amazing. Thank you. So this is our morning, guys. We're going to talk about the rules. We're going to talk about, you're going to show me what you're doing. You're going to get feedback on everything that you do. I'm going to hand you a plan that has been proven to win more than it loses, and you're going to be able to look at these patterns and recognize them so that they become easy. So it's only 3 rules. We're going to start with the first rule. Seems like a great place to start. And the first rule is the large chart, the big chart, the slow chart, the large crowd. They have to provide you strong trigger lines. Strong trigger lines give you the advantage of momentum. In order to have strong trigger lines, you have to be trading with the trend. So if the background is green, it's up. If it's red, it's down. It means that both of your trigger lines must be green as well in an uptrend. They must be red as well in a downtrend. Strong trigger lines is defined as when the small triggers break up and above of the large triggers. Whoops, I dropped my thing. Um, and it's not just the colors, but rather it's the separation between the trigger lines. It is the separation um, between trigger lines, small and large, letting you know that the triggers are strong. Guys, I'm going to help somebody out real quick. If you need to post in my room, you're going to see the chat box on the side here. You have to click on the little box icon. It'll open it up, and you can type directly into that chat box. And once you hit enter, it's going to drop the question in the room. So guys, in an uptrend, small's above the large, large or wide, space between the two. This is my strong trigger look, and when I have this strong trigger look, the odds are favorable for the market to continue in the direction of the trend. In a downtrend, small's below the large, large or wide, space between the two. The odds are favorable for the market to continue down. That separation means strength, guys, and that odds favorable for the market to continue in the direction of the trend, we're going to whittle that down to odds favorable momentum. You're going to see that annotated on charts all day long. OFM, strong triggers, guys. The advantage of rule number one. This advantage goes away when the small triggers work their way inside of the large triggers. Because when the smalls work inside of the large, guys, this is what we call weakness. And when you have weakness, Sam, did you get that on how to chat, how to post in there? When you get weakness, anything can happen up or down. I'm a huge fan of language, guys, and I think that when you embrace the language a little bit, you start feeling like you want to be in a trade because the odds are favorable for it to push in the direction of the trend, and you get a little hell-bent on pumping the brakes. With weakness, why on earth would I risk my money? If anything can happen, there's not an edge there, guys. So rule number one throughout the day is going to happen. You're going to see these great big pushes, great big pushes, great big pushes, great big pushes. If you go back and study this a little bit, you're going to begin to trust that strong triggers really does move a market. And you're going to notice in your study that weakness very often results in some form of reversal, guys. And on this particular picture, 4 out of 5 pivots came from weak triggers. So strength drives a market. Weakness, anything can happen. The advantage is gone. You guys good with that? I see some old faces coming back in the room. Nice to see you. Guys, strong triggers leads the way. Strong triggers is hard to stop on that large chart. And Lonnie, the short answer is no. On the 15-minute, if you waited for everything to be in your way all the time, it's too slow of a chart to have that sort of advantage. That's why we use 2 charts. No whys in the room. I'm going to assume everybody is an expert on momentum. So we're going to go to termination conditions. Guys, termination conditions. They can stop a market. They can reverse a market. They can create a big, ugly bounce. They could break. The reality is, I never know what's going to happen. I never know what the people in charge are going to do. Rule number 2 gives me a heads up on where they're most likely to make things happen. Guys, a termination condition is really just an indicator that may reverse the market. And it's a comparison of that indicator, whether it is support, resistance, one-to-ones, divergence, highs and lows. You're going to compare them to those T3 trigger lines. And the trigger lines are going to let you know if you should pump the brakes and sit on your hands. So a reminder, the areas that can stop the market on a large chart, that could hinder forward progress, that could create an untradeable bounce, guys, we're looking at those divergence highs, that magenta line. And on its own, it's not a termination condition, but when price comes back to it, it acts as a line in the sand. You're going to look for red Fibonacci resistance, blue Fibonacci support, guys, yellow one-to-ones, divergence lows. And what you're doing is you're saying to yourself, man, these are where decisions are most likely to be made. These are where highs are most likely to happen. These are where lows are most likely to occur. So in order to identify one of these areas as a termination condition, we're going to let the big crowd get there. You're going to let your bars, your price bars, reach the area. So from this point here, the market is going up. It continues up. and then price reaches an area, and this is the first step in the process. Once price reaches that Fibonacci resistance, whether it is Fibonacci resistance, whether it is a divergence high, or whether it is a yellow one-to-one, the only thing that you have to do is ask yourself, where are my triggers? And if your triggers remain below resistance, and they have in this picture, both small and large are still below the red line. This red line is a termination condition. That's the recipe for defining it. And what a termination condition means to you is that something could happen there that could pull you out of a trade. The market could have a big bounce that you can't trade through. The market could break the area, or the market could reverse completely. And the reality is you're never going to know what the reaction is. So when rule number 2 is not met, when price reaches resistance and the triggers are below, you're simply going to say, I'm not going to trade into that area. And then the market comes down, all the momentum, and we reach Fibonacci support and yellow one-to-ones. And when price reaches those areas, ask yourself, where are my triggers? Guys, if the smalls and large remain above the areas, guess what? That's a termination condition. It could create a big untradeable bounce. Guys, it could create a reversal. It may even break. And the reality is, once again, you will never know what the reaction's going to be. They don't send out a memo. There's not a blimp that flies by your house. So if rule number 2 is not met, if the triggers remain above support, absolutely no trades into that area. And guys, rule number 2 is designed to keep you safe. Rule number 2 is designed to keep you patient. Rule number 2 is designed to make sure that that advantage of momentum isn't hindered. Areas break, guys. And that's what produces a clear path. Clear paths can come from either an area breaking when the small and the large triggers. Remember, the trigger lines tell the story. When both the small triggers and the large triggers get above resistance or below support, that's when the area is considered broken. That's when the path is now clear. And this is a breakout. It's a breakout of Fibonacci, and your trigger lines tell you that now the path is clear up. You'll also get a clear path from a reversal. Here's the problem area, and you're waiting for it to either break or for the market to reverse. And once the market reverses and gives you your rules met, you've got that clear path all the way down to Fibonacci support. And once you reach the next line, guys, the process starts over. Price reaches an area. Where are my triggers? Are you guys good with that? For the brand new user, it's either a termination condition or it's a clear path. And I'm telling you, the easiest money, the easiest trades that you will ever take will have not only a clear path, but also momentum, guys. And these tails that you see on a large chart, remember, we're still looking at a large chart. These tails that you see, that's that refinement. That's that pullback, that bounce, that continuation on a smaller, faster chart. You're actually going to be able to pinpoint with rule number 3 where these tails are most likely to form, guys. And these breakouts happen, these reversals happen, and it's the patience waiting for the first 2 rules that's going to produce the easiest results. I even took a picture this morning. So that is a breakout that produces a tail and gives an awesome opportunity to win. Rule number 2, guys, is going to define problems. It's going to define consolidation. It's going to define chops. And any of you folks that come to me with experience trading in the markets know that one of the biggest sources of pain for traders is getting caught in consolidation. Rule number 2 is designed to help keep you out of that. And you'll see that resistance holds and support holds and resistance holds and support holds. And the market is clearly defining a range that it needs to break out of before you have that clear path. This is 90% of your day, being patient. And then once it breaks out, small's above the large, momentum is there, small and large get above resistance, it's behaving as support. My little pew-pew pointer is right on that tail where you guys are going to find the ability to trade that breakout with momentum, letting the trigger lines tell you that it's okay to take a shot. And sure enough, momentum carries you right up to the next area. Rule number 2 is going to keep you patient. Rules 1 and 2 combined are going to help you find opportunity. And guys, those are large chart terminations. Everything that we just talked about happens on the large chart, the big chart, the slow chart. You're going to define direction, you're going to define momentum, you're going to define termination conditions. Once those first two rules are met, you're going to look for an entry. That's the small chart. That's the refinement chart. There is one time where on a small chart, I'll choose not to take the entry. There's one termination condition that you'll see on the small chart, and that is 3 divergences. 1, 2, 3, negative numbers, cyan lines from a low. 3 divergences is the small chart showing you change that you can't see on the large chart. The market is going down and there's a loss of momentum, and they try to push down again and there's a loss of momentum. They try to push down a third time, and for the third time, there is a loss of momentum, guys. This is the small chart telling you, hey, even though this chart has odds favorable momentum, we might push up a little bit. We might push up a little further. There's just not enough steam to push it anymore. So 3 divergences in the same price range can terminate a trend. It's effective on a small chart. If you see it on a large chart, that's when you typically see bigger moves the other direction. So, guys, rules 1 and 2. The advantage of momentum. It's hard to stop momentum. The advantage of a clear path. Making sure that there's nothing to create a bounce, to mess up your good time when you're riding that wave of momentum. Once you have them, we're going to go to the refinement chart, the entry chart. And the entry rules say that you're going to use a limit order to buy or sell a pullback at an area inside of triggers, guys. You're going to call your shots to the point to where you're going to have a limit order waiting. It's going to be waiting at a fib, at a mid band, at a yellow 1-to-1, because the same way areas on the large chart can stop a trend, they can create a bounce to send the market off in the direction of the large chart trend. But we want those areas to be inside of triggers, guys, because triggers are going to define retracement zones. So rules number 1, strong triggers. This is what it's going to look like. Rule number 2, no termination conditions. This is what it's going to look like on your large chart when it's time to find an entry. You're going to wait for a reversal bar. It's going to happen at the very bottom of this bar. And guys, this is the small crowd fight. And when the reversal bar prints, the large and the synthetic triggers, the large triggers, these are native to the 5-1. You'll use them with the small to define momentum. And the synthetic triggers, these are nothing more than the large triggers from the large chart. These define where that retracement is most likely to go, and then the areas inside of that retracement zone, fibs, midbands, yellow 1-to-1s, they define where the market is most likely to bounce and continue down with the large chart. Takes one bar on the large chart to know the rules are met. Inside of that bar is how we refine to define an entry. So we're going to keep it going short, and we're going to go through the process. When the large chart rules are met, such an important concept. When the large chart rules are met, your job is to wait for a reversal bar on the small chart, and you're going to be tempted to jump in. And guys, if you jump in, if you just can't hold your water, this reversal bar is a great exit because it means that you've lost the momentum. Once the reversal bar prints, you'll be able to look at your large and synthetic triggers, and you'll be able to say with confidence, this is where this retracement is most likely to go. Somewhere from the bottom of the line to the top of the line. I'm not sure where, but that's my zone. And then you're going to take it one step further. You're going to say areas inside of that retracement zone. That's what creates a bounce. I want you to think of a tennis ball. And that tennis ball is being thrown as hard as you can. That mid-band is the brick wall, guys. This is where the small crowd is most likely to fail. This is where the market's most likely to bounce, continue with the trend. You're going to activate a limit order 2 ticks below that area inside of triggers. That becomes your entry for the highest probability trend trade. Because you can define the retracement zone, because you can define the areas most likely to bounce, you're going to learn that your advantage is no longer present beyond that retracement zone. The advantage is no longer in play if you blow through those areas, guys. So any area, any fib, any midband, any yellow 1-to-1 on the wrong side of triggers, above those triggers for a short trade, this is where the advantage of rule number 3 is no longer in play. We're actually going to call this where the market should not go. In an uptrend, large chart is up, large chart is strong, triggers are screaming, life is good, I can't wait to take an entry. and I'm going to wait for a reversal bar on my small chart. I'm going to let the small crowd fight. The reversal bar is not my entry. The reversal bar is letting me know that the retracement has begun. So I need to look at my large and synthetic triggers and say, okay, they're most likely to push down in this zone right here, somewhere from the top line to the bottom line. And I remind myself, triggers aren't bouncy. I need an area. I need a fib, a midband, or yellow 1-to-1. In this case, I have a midband inside of that retracement zone, but I also have yellow 1-to-1s in that retracement zone, which means that I have to create a window. I have to say to myself, I have two areas where the small crowd may fail. I have two areas where the market is most likely to bounce and continue with the trend. I've created a window. I like to call it the window of opportunity. And this window signifies where the market is most likely to continue up. But because of the large chart advantages, because the large chart has momentum, because there's absolutely nothing in the way to stop its forward progress, I'm going to activate a limit order 2 ticks above the highest point of support, closest to the reversal bar. Because I don't want to stumble over a couple pennies hoping it goes lower, reducing my risk. Guys, I'm going to get in up here. I don't want to miss this trade. I have everything that I need. I have an edge. I have an advantage. My advantage goes away on the wrong side of the triggers, below the retracement zone, below the areas most likely to create a bounce. We're going to call this area where the market should not go. If this is really going to be part of that 70 to 80% winners, it should not go below those triggers. And you're going to use that concept for your initial stop placement. So you didn't even realize this, but by learning to define where the market is most likely to continue, you have defined where the market should not go, and initial stops are placed there. Generally 4 to 5 ticks above the trigger lines for a short, 4 to 5 ticks below the trigger lines for a long. Because this is where the advantage is gone, and that is a wonderful reason to exit a trade. What you're going to find with a little bit of study, with a little bit of practice, with a little bit of repetition, is that you're just trading a pattern. And this pattern typically wins 70 to 80% of the time, which means that this pattern is obligated through math to lose 20 to 30% of the time. You placing your initial stop where the market shouldn't go gives you the ability to take smaller losses and simply wait for the next trade, and you're going to find that taking losses is a normal part of a positive equity curve. I've never met a day trader that doesn't lose. I myself take losses every day. The goal is to have enough advantages in play to have that pattern that wins more than it loses, that you can mitigate those losses, that you can find a way to end the day positive because of the patterns you trade. So this is the pattern complete. Are there any questions? I don't want to leave anyone behind, guys. I want you to be very vocal if you need help. Are there any questions about momentum? Momentum is simply a separation between the small and large triggers. It has nothing to do with Fibonacci resistance, with mid-bands, with 1-to-1s. It has nothing to do with price bars. It's simply a separation of the triggers. Rule number 1 is met. Rule number 2, giving you that clear path, small and large triggers get above that resistance line. That resistance behaves as support, and we haven't reached the next area. Rules 1 and 2 are met on the large chart, and because they're met on that large chart, you're going to go look for an entry. Your entry is the pullback to the areas inside of those triggers, guys. And what this entry looks like is just a tail on the large chart. So you can use this idea. You can go back and study this momentum and path and circle a tail if you see it. If it lines up with an area inside of triggers, guys, that's your best of the best trade. That's your highest probability trend trade. That's the trade that's been proven to win more than it loses. That's the trade that's going to bring new users success that they're looking for. And momentum and path, right there. Does everybody see it? And I'm sure a lot of you took this trade. That was 6:30 a.m. The market pulled right back to resistance inside of triggers. Does everybody see that? That's your pattern, guys. This was 6:34 a.m. I guarantee there's pictures of it in the room from Nexgen users. What you're studying right now is this look right here. When you either have a clear path and momentum or if you have the potential to break, you can even take a look at it. And what you're going to say is, without the momentum, there's no reason to circle that tail. My rules aren't met. What you'll find is if you go through this drill, there will be spells where you don't have a trade. There will be times where your rules aren't met. This is 90% of your day. 90% of your day is doing nothing. But your patience is very often rewarded. Not trying to go long without momentum keeps you from taking the loser. Not trading directly into an area where the triggers haven't broken typically keeps you from taking a loser. Choosing to not trade with weakness is going to help you avoid losers, guys. And avoidable losses are the biggest killer of accounts. It's not your inability to make money on the perfect trade. That's going to be there just rapidly. It's going to be your ability to do nothing when the advantages are gone. It's going to be your ability to sit on your hands and to remind yourself, hey, the next trade is coming. I just have to be patient. So to get there fastest, I'm about to give you everything you need, guys. This is Chart Reading 101. And this was put together to help you guys focus on the large chart advantages. You're going to see in this room that when users have momentum and path, they typically win. There's more wins than losses with that recipe. So we're going to define strong triggers, weak triggers, clear path, termination conditions. We just did it. We broke them down individually, how to identify them. So now you're going to go take pictures of them. You're not going to go take a trade. You're going to go take a picture of strong triggers. And you're going to annotate on that chart. You're going to write, these triggers are strong because there's separation between the small and large. These triggers are strong because they're trending in the direction of the overall trend. The separation is strength. This is rule number 1, Matt. This is odds favorable. Write whatever you need to write on that chart to create the brain response to the look. This is what it looks like. This is what it means to me. That's your commitment to take a trade, is with those strong triggers. Weak triggers, you're going to go take that picture. And you're going to say to yourself, these are weak. There is no momentum. The smalls are inside of the large. Rule number 1 is not met. I choose not to take the trade. So brand new users, it's really pretty simple. Whoops, wrong direction. You either have the advantage of momentum and you're going to recognize it, you're going to annotate it, you're going to talk about it, or you have weakness. And only one of them gets you looking for rule number 2. And rule number 2 is going to make sure that you have that clear path. And that clear path is always the clear path. It's defined by the small and large breaking through an area, having not reached the next area, or by a reversal turning the market, giving you that momentum and the next area isn't reached. And you're going to go through and you're going to take these pictures. You're going to take these pictures of momentum. You're going to take these pictures of termination conditions. And what's going to happen is you're going to wake up in a week from now and you're going to be really good at this stuff. And you're going to be really good at reading that large chart. And it's going to take you about 2 seconds. Have a great day, baby. Going to take you about 2 seconds to know that it's time to go look for an entry. So that's the high probability, or that's the Chart Reading 101. For the new users, it works together with this. This is the high probability trend trade checklist. This is the highest probability trend trade checklist, the best of the best. Guys, this is rock star status for entering the market, your best chance of success. And it starts with a strong top or bottom. And most of you are going to say, but hold it, there's only 3 rules. Guys, this is not a rule. You can take a high probability trend trade without a strong top or bottom, but this sweetens the pot, guys. When I have a termination condition, absolutely no triggers through, that reverses the market, guys, that's a strong top. The decisions made by the large crowd were so impactful at that key area that the buyers lost, the sellers took over, and now your rules are met. We're going to ride that wave of momentum created by the sellers. The same is true. No triggers through termination at support. When it reverses the market, if my rules are met after that strong bottom, it's the highest probability trend trade you could ever take. This strong top or bottom is going to show up later in life. The second trade on the plan I'm giving you requires a strong top or bottom. The Nexgen HVA trade requires a strong top or bottom. The momentum trade requires that no triggers through termination. So begin to recognize it. Write it on your chart where the market's coming from. Your checklist asks you, do you have momentum, separation, or is it weakness? Time to sit on your hands and do nothing. These will help you with the picture taking. You have to be able to define whether or not you're trading into a termination condition or whether you have that clear path. For the brand new user, it's very black and white. It's either a termination or a clear path. Once you understand that, it opens the door for number 2 here. This is going to be the second trade on the plan that I give you guys. And the second trade is what we call a 50-50 trade. And if triggers tell the story, triggers define that trade. 50% of my triggers, the small, have absolutely smashed through an area that could be problematic, but my large triggers remain above 50% of my triggers. I know that it's not a true termination because the small are breaking through. And I know that it's not a clear path because the large haven't. This is the transition as a Fibonacci area breaks. I'm going to give you a recipe to take trades here, but it's what we call a medium probability trade because the path isn't clear. You're going to have to use your chart reading to manage those a little more assertively. And then finally, it helps you define the entry on the checklist, and it uses that magical word inside of triggers from reversal bar to entry, guys, and where the market shouldn't go. The second page is a printable checklist. This is how you're going to police yourself. This is your focus as the beginning. You're going to mess it up. You're going to break rules. Hell, I don't care if you've been with me for a year. You're still going to break rules some days. People make mistakes. It's okay. If you're a brand new user, if you write these 4 concepts on your chart every time you take a trade, if you take the time to identify the momentum on the chart, if you take the time to identify the path, if you show me the entry, you show me the exit, what's going to happen is, one, you're going to have a commitment to rules. This is what you're going to be focused on every trade. You're going to see the good, you're going to see the bad. And by writing these on the charts with a yes or a no, you're going to know whether or not you had those advantages. You're going to know what you're up against if you choose to take a trade without one of them. Nobody in the history of this checklist, and this is the part that I really want to set in with you guys, nobody in the history of this checklist, this best of the best way to take a trade, has ever followed this checklist to the letter and done worse than 70% with it. Typically, the people that can mark yes to all 4 are finding themselves in about an 83-84% range. That's been the historical results. I've had engineers put it in the ringer and try to beat the hell out of it over 400 days, and they still ended up in 82-83%. So this checklist is the core of the plan I'm about to give you guys, and this is the KISS plan. And the KISS plan is designed to optimize your chances of success with that high probability trend trade from start to finish, from entry to exit. The KISS plan is a stepping stone, guys. This is your first trade, not your only trade. This is the trade that's teaching you to read your indicators. And then through simulation, through study, through class feedback, through continuous practice, you will be empowered to craft a plan tailored to your personal goals. And it's going to be based on your experience reading the indicators, guys. So as you sit down and you're learning to trade, make all the mistakes on simulator. This is the batting cages. You can't strike out. This is the driving range. You can't. It's at the bottom of this one. It's on that KISS plan, Better Dad. I'm going to give it to you guys in just a second. I'm going to give you guys everything that I'm showing you. Every one of these documents. Asking for a friend. I love it. I'll tell you what, do me a favor. Here it is individually. It's at the bottom of that. Give it to your friend. So guys, no, it's no worries. Don't ever be sorry. Guys, I post these every day 1,000 times a day. It takes me a half a second. I will do it 1,000 times a day if that's what you need. Things that you need to know before you sit down to trade, and you're not in those batting cages or on that driving range. You're not in the simulator, guys. It's time to do it for real. This is what we call a plan. You have to know why you will enter the trade, guys. And the best rule is that your rules are met, because your rules are describing a pattern. Your rules are letting you know that you have those advantages, guys. And this pattern has to be proven to win more than it loses. And you have to test this pattern. You have to go back and circle those tails. You have to believe in it. And once you believe in it, there's no reason not to consistently enter. You know that for every 10 trades you take, you're likely to win 7 or 8, and you're likely to lose 2 or 3. So you begin to accept that losses are a normal part of a positive equity curve, that losses are a part of being a day trader, guys, and that's going to help remove the emotions. John Novak used to take trades, and I was like, man, I hope it wins. And he would very, very bluntly say, I don't give a shit if it wins. I have an advantage. I have my edge. It might lose. I can't let that upset me because it's the right trade. You will get to that point. It's a lot of fun to be there. And then you have to know why you'll exit. This is where chart reading comes in. This is where speaking in terms of advantages comes in. Exits are taken either at profit targets or when the advantage that had you enter the trade is gone. So a good example of that, if you enter the market at the area inside of favorable large triggers and they push 4 or 5 ticks beyond those triggers, guys, your advantage of rule number 3 is no longer in play. It's okay to exit that trade. If you're in a high probability trend trade and 3 divergences print, your advantage of a clear path is gone. It's okay to exit that trade, even if you haven't reached your profit targets. So you're going to use your chart reading and your understanding of advantages to translate into a management plan. But it takes a little time. So the KISS plan, first it defines entry with that best of the best checklist, but then it focuses on management for the new user. And guys, I wrote this as the most basic plan I could ever write for a brand new user. It is the most mechanical plan. It is 100% if then. And if as a brand new user, you keep your management this mechanical as your entries were, what you're going to find is that you have the ability to make money day in and day out. You have the potential to win more than you lose. And guys, this management plan is 2 contracts, and it's designed to help you understand stop placement, where the market shouldn't go. But more importantly, and I think most importantly, it's focused on getting paid, focused on taking profits, accepting that it's okay to remove contracts from the market, even though you believe it may go further, guys, because the goal of trading is to make money. And this helps you get money in the bank quickly in the highest probability scenario. You will craft a plan tailored to your personal goals based on your experience reading the indicators. So your very mechanical management, 2 contracts, 1 to get paid, 1 to build trust. If your entry is 2 ticks below resistance inside of favorable large triggers, that might sound familiar as a high probability trend trade entry. Then the initial stop is 4 to 5 ticks beyond the triggers. This is where the market should not go. You will know your risk before you ever enter a trade. You will know exactly where your stops go before you ever enter a trade. So if your entry is 71.34 and your stop is 71.49, you know you have $150 risk per contract on this trade. You have to accept it. This is where the market shouldn't go. Targets are predefined at $100 and $200. If they don't stop you out, if this isn't part of your 20%, you're going to get a reversal bar printing in the direction of the trade. That reversal bar is going to redefine where the market should not go. Because this reversal bar is telling you, it's confirming, hey, we're going down with the trend. We're going down with the momentum. We're going down with the clear path. We're going down from the area inside of favorable large triggers. Guys, you're going to put a stop 2 ticks above it. That's where the market shouldn't go. You now have $30 risk per contract rather than $150. And it doesn't guarantee a winner, but it definitely guarantees a much smaller loser. If they don't stop you out, it means you hit your first target. Your first target is $100. And this target was hit on the second bar coming off of that area, guys. $100 goes into your account. $100 dries up your sweaty palms. $100 lowers your pulse, removes some adrenaline. They can't take that from you. And now you're going to move your stop to break even. And you'll notice I didn't say where the market shouldn't go, but you're going to take all of the risk off of this trade. You're going to have money in the bank, and this is what's going to help you trust that large chart, that momentum and path are more likely to take you to your second target than it is to come stop you out. If they go to your second target, congratulations. You just made $300 and you've exited. It doesn't matter if the market drops another 20 points. It doesn't matter what happens next. You are out of that trade. You can breathe again. You can go pet the dog and celebrate. And that is a $300 trade for about 3 minutes of active trading. in your morning. There's a lot of people in this room that don't believe $300 is enough money as a trader. Guys, I'm going to tell you right now, $300 a day, if you can capture it consistently, make that happen every day for a trading year, is a $75,000 year. You could mirror that $300 on other accounts and make it a $750,000 year if you wanted to, but it's based on the ability to consistently grab profits, guys, to close out your day in positive equity instead of giving away on the wrong trades. As you grow, you're going to figure out how to make more. My thing is I love trade copiers. I think trade copiers are amazing. I could take one trade for $100, guys. I could mirror it on 10 accounts and make $1,000 a day based on one trade. And $1,000 a day is $250,000 a year based on a $100 victory and then going to play golf. It's not a bad not a bad way to make a living, but you've got to go through the process, guys. You've got to learn how to do it. And I'm going to give you everything you need to do that. So I just dropped a zip file in the room called All You Need. The zip file has the chart reading 101. Guys, learn these rules individually. Learn how to identify momentum and then go look for the clear path. And then once you get the clear path, then go define your entries. Don't put the horse before the cart or the cart before the horse, whatever that saying is. High probability trend trade checklist. As you learn to be a chart reader, make sure that you're reading the correct looks. This gives you the KISS plan, the highest probability trend trade, and then taking you to that medium probability 50-50 trade. And I'm going to show you the 50-50 requires a strong top or bottom. The other one doesn't. The 50-50 says absolutely no divergence on a small chart. The other one doesn't. So learn one trade well before you add a second trade so you don't confuse the entry rules. And management, of course, is different as well in a medium probability. It's more aggressive. So get really good at one thing before you add the second thing. Remember that it's all about making money, guys. It's all about getting paid, taking profits out of the market. I encourage everybody to name their trades. I am entering a high probability trend trade. It means that you know the advantages that got you in, which means that you'll know what it looks like when those advantages are gone and you have to exit. This one is in the file. This is going to help you create a management plan for the high probability trend trade and the trades beyond. There's one in there called the pictures you can take. I take pictures pre-trade and I'll go back and look at it and make sure I didn't miss something. I'll take pictures during the trade, and that's how I work on management. I'm going to show you when I am actively trading. I just want to take the picture up from, let me see where the down starts, from about right here to over here. So 9 pictures, that's one trade. 9 pictures, stop movement, making sure nothing's changed, working on my management plan. You can take pictures after the trade. These are the ones that I want to see in the room, guys. The pictures after the trade where you go back and you clearly define your momentum, your path and entry, and talk about the whys so that you create that recipe for success for that long term. And then I like to take pictures of no trades. If there's a termination condition, I'd rather take a picture of it than a trade into it. If there's no momentum, I'd rather take a picture of those weak triggers than trade without that momentum. So the no trades are great too. And drop these in the room. Number 3 and 4, your awesome trades start to finish, win, lose, or draw. And then when there's not a trade. And I want to show you why I think the no trade is so important. Let me find the picture. I lost my pictures. Because this is pretty common. It was for me, and it seems to be for a lot of people. Where on earth? There it is. A lot of times people will post a picture in the room, and they will say, Mark, I didn't take this trade because I didn't have room to my termination condition. And what that does is that opens the door for a lesson that when you buy the pullback at an area inside of triggers, the room determination conditions quadruple. So unless you hit the line on the large chart, you're going to have room to your targets. Sometimes people say, well, Mark, there was one-to-ones. I didn't want to trade into a termination condition. And I'll tell you, guys, termination conditions are a large chart thing. Unless you see three divergences, you're taking that trade. And they're like, oh my gosh, I've been talking myself out of so many trades. That was my thing right there, one-to-ones on the small chart. Had someone tell me once, well, Mark, I've lost momentum. I can't take that trade. The small triggers turned against me. And then I have to remind them that momentum is on the large chart. It's a large chart endeavor, guys. And without this little roll of the triggers, more often than not, you're never going to get to your best entry. Don't let the small chart talk you out of large chart trades. So post those no trade pictures in the room. You'll be glad that you did. It'll open doors for you. And then finally inside that zip file is this one right here. So my goal, my hope, my wish, my want, my prayer, whatever you want to call it, was that you could walk up to Nexgen and you could say, you know what, I want to use your software, but I can't attend class. So what I do is I tell you, well, this is what happens in the classroom. 5 days a week, you get 3 rules, 2 charts, skill set to recognize advantages and turn them into trades. In the classroom, we discuss each rule individually. You'll understand how to use them, the Hobbes probability trend trade taught. Guys, that's the classroom, is to teach you the best of the best entries. The advantage of momentum, the advantage of no termination conditions, and the advantage of an entry. And then it reminds you, so whether you're in my class or not, if you focus on momentum and path, if you learn these 2 concepts, you can create a consistent, profitable trading plan. Study them, learn them, commit to them, and once the recognition is second nature, you will find your best entry. You will grow outside of the basics. Until you do, the high probability trend trade gives you the trade that embraces the advantages, has the potential to win 70 to 80% of the time. This is the trade that helps you recognize the advantages of momentum and clear path, that builds confidence in them. It's not your only trade, it's your first trade. Learn it and the possibilities seem endless. So my disclaimer, I'm not harnessing you to this, guys. I'm giving you the best of the best to help you find success. This document talks about the rules. It tells you exactly where to find them. It shows you precisely the indicators that you're going to use to achieve it. And it breaks down each advantage individually the same way we did in the classroom, using pictures, using examples, all the way down to the entry advantage, step by step to get you into the market and how to study it, guys. This document will walk you through everything that you need to find success with the software. So whether you are in my class or not in my class, if you can get through this and be comfortable, you're going to get to where you want to be. So let's summarize. I do love to summarize. We have this morning collectively learned the trigger line and the Fibonacci rules for when it's okay to trade. If you're day one, you're like, what the actual heck is going on? This is confusing. I don't understand these things. That's okay. Go to that second document. Create a little recognition. By day 3, it really does start to click. Typically by day 5, the average new user begins to see the entries. You guys all have the ability to simulate. You can practice, and most importantly, this room is open for feedback, guys. This room is designed to give you feedback on what you do that's right, that's wrong, what you're doing great, what you need help with, and then most importantly, giving you the feedback to fix the mistakes that you're making. You now have a plan. It is true. Todd, I was thinking of you when I said that. I've said it to 1,000,000 people, but you happen to be in the classroom. I've given you a very simple plan. And you're saying, well, Mark, it's not simple. It will be if you keep your study focused, guys. And that plan has been proven to win more than it loses. And I wish Chef was in here because he'd tell you he's people. I've had people get funded in these prop firms in the first 30 days with the KISS plan, keeping it basic, keeping it focused, learning how to get paid. Your job, and the thing that I can't make you do, force you to do, or put my will upon you, is you've got to do the study to make these looks easy, guys. You've got to post in the room and ask for help. The only people that I refuse to help are the people that I don't know needs help. If you don't raise your hand and say, Mark, the hell is a trigger line? I can't go through and describe trigger lines to you. And Mark, the hell is a termination condition? Why do you keep saying that? Guys, all you have to do is ask, and we'll talk about it. We'll break it down. And thanks to your great questions, guys, I have reconstructed my education 1,000 times so that it appeals to more people. Squeaky wheel gets the grease. So we're going to go to the second hour now. And the second hour is feedback. Whoops, let me save that. The second hour is looking at your charts. It's talking about your charts, what you did, what you saw, what you felt, what you wished. And guys, I'm not going to beat you up because you traded into a termination condition. I'm not going to beat you up because you didn't have momentum. But I am going to go back to these three things on every chart because it is an educational room. So if you're posting in the room, and please don't take this the wrong way, and you break every rule and you're like, I made $1,000. Guys, nobody in this room has ever bought me something pretty with your profits. I don't care about the money you're making. We're focused on learning to read indicators. We're focused on the process that yields results. So every chart, I'm going to discuss these three things, whether they're true or not. If you chose to take a trade without them, I'm going to try and celebrate every victory. And guys, if you got lucky, I'm going to tell you, you probably got lucky on this one. You gave up so much stuff. The market went on an act of God, not because you were a skillful trader, because short-term victories that don't follow a plan typically lead to long-term failures. And then the last thing, I'm very, very mouthy today, I know that. Guys, the key to everything that we do, everything that you do, really everything in life, guys, create a base, create a foundation. This is your freshman year in college. This is English 101, this is Biology 101, this is History 101, guys. Create that foundation and then grow from the foundation that you've built. Get 1% better every day. That's the Japanese philosophy of Kaizen. So for you brand new users, this is where I seem like the killjoy. For you brand new users, I blanket you with very conservative rules. We focus heavily on the recognition of advantages, and you are handed a solid plan that optimizes your chances of success as you learn to read your indicators, guys. So for you new users, terminations are bad, no momentum is bad, areas on the wrong side of triggers are bad. And these blanket rules are in place because it increases your likelihood of success. Success breeds confidence, guys, and confident traders are less likely to deviate from their plan. They're not always bad. Your plan may change and stray away from following some of these rules based on your chart reading, but in the beginning, focusing on not creating exceptions in the moment typically creates more success. And just like anything, the more time you spend with the indicators, the software, the time in the market, the more you see, the faster you see it, the more aggressively, assertively you can manage when an advantage is gone. So learn the process that yields the results, guys. Focus on the execution of the method, momentum, path, and entry, rather than focusing on the money that it's going to produce. And very often, the money produces itself from following the plan. That's where the KISS plan comes in. If you keep it that basic, guys, if you follow simple rules, if you're looking for the best trades instead of all of the trades, you can, and it's been proven by you guys over and over, you can find an extraordinary level of success. I've been watching it for years. And the further you deviate as a brand new user, when you walk in here and you say, man, I want to trade like Bob and Gary and Ron and Todd and Lonnie and Morgan and Andrea and Sam and Muser and Vad, and I want to do everything they're doing, but I don't have a freaking clue what I'm looking at. Guys, you're just going to frustrate yourself. Stay in your lane, follow your plan, do your thing. I'll help you with it every step of the way. Question everything. If you don't understand something, ask. If you see something that doesn't make sense, show me the picture, tell me. And give yourself a little bit of grace. You're new. You're brand new. Brand spanking new. You would never yell at a child for not learning how to ride a bike on the first pedal, guys. I'm not going to beat you up for not being a super day trader in day one. We're going to grow together. Give yourself a little grace, guys. You're going to be harder on you than I ever will. When you talk to yourself, Pretend you're talking to a 4-year-old. Give yourself that grace. All right. This is crude oil. And crude oil has large triggers down and small triggers up. I don't have momentum. I don't have a clear path up because price reached resistance and all my triggers are below it. And I don't have a clear path down because price reached support and all my triggers are above it. Ladies and gentlemen, you are caught in a box. Absolutely no rules, mate. Go make a sandwich. I'll be back this way in about 5 minutes, guys. Nobody said spanking, Ron. I'll see you guys in 5. Talk amongst yourselves. Post them if you got them, and then we'll start going through everybody's charts when I get back. All right, y'all. I am back. Better Dad taking a break. That's okay. We'll skip his stuff until he comes back. Guys, I'm going to scroll up to the very top of the room. And I'm going to warn you right now, there's some trades that were posted that do not fit the rules that we talked about in this first hour. It's not my job to be the trade police. It's not your job to be the trade police. So we're going to start with Pete. And guys, I love this. Pete will throw 5 or 6 pictures in the room. 1, 2, 3, 4, 5, 6. And Pete will say, check it out, Mark. This is what I've been up to. This is how I saw it. This is what I did. This is where I did it. And guys, it's not my job to tell Pete that he's trading correctly or incorrectly. It's my job to make sure that his read is accurate. And he says the market reversed out of nowhere. And that's a weak bottom because it wasn't a termination condition that created the reversal. So he's just identifying where the market is coming from. He says, I have odds favorable momentum. And he says it broke all the terms. And I disagree 100% with Pete on this chart read. It did not break all the terms. At 61.66, which is right about here, he only had the potential to break. It didn't break at all. And that's okay. Pete is saying, check it out, Mark. If decisions are made at key areas, I'm going to let my small chart get completely above that area. And I'm going to use odds favorable momentum. And I'm going to see if I can't ride that momentum up a little bit, guys. He's recognizing the momentum on 2 charts. And he's saying to himself, and Pete, I know I'm putting words in your mouth, and I appreciate that you're a good sport. Pete is saying to himself, I'm going to show you exactly what it is. Check it out. I learned in class that decisions are made at these key areas. And I learned in class that momentum can break key areas where decisions are made. And if I have momentum on both charts, I'll let the price on the small chart, I'm not going to worry about the triggers, but I'm going to take price action away from the decision-making point, and I'm going to take quick profits on the way up because I know that it's only momentum. And Pete does this expertly. Quick profits, gets out, and then notice that he sits on his hands. He waits. He's not trading into the area. But when everything begins to break above again, he says, all right, let me get above the decision-making point and see if I can't ride that trade up again. Is it a clear path? Not at all. Did it break all the terms? Hell no. Guys, this is that 50% or that 90% for the brand new user. You finally get above this area, but you're into that area. And you finally get above this area, but you're into that area. Guys, for the new user, there's a lot of patience and probably not a trade. But when you do that chart read, when you understand momentum, when you believe in momentum, you will find a way to capitalize outside of the very basic rules. Nice job, Pete. Weak top again, odds favorable, get below the decision-making zone, trade to the decision-making zone. There it is. That is a 9 ticks. 9 ticks on 4 contracts, guys. That is $360 over the course of a matter of seconds. That's $360 without doing a darn thing all the way down here. It's a $75,000 a year based on that snippet. Nice job, Pete. Weak top again. Odds favorable momentum. And then Pete, this is where it gets a little wonky because at 6 a.m., something's wrong with your, no, it's not. You hit the termination condition for sure, and it bounced back up. And I don't even know what kind of trade this is. This is trading directly into a termination condition when your small chart said that it might have held. So maybe you pulled one over on them here. And then when everything starts back down again and agrees, there's that jump in, jump out again. Nice job. There's that one, making money. And then you were writing on the other chart and missed this one. And that's that perfect look, guys. That's that momentum. That's that path. That's that pullback. That's that easiest money. Does everybody see the one that Pete missed is the easiest trade you'll ever take in your life? Momentum, path, straight to the next fib. That's all right, though. Pete's doing okay without it. And then termination condition. And this time Pete chooses not to trade into it. Notice that there's not momentum. Here he had odds favorable momentum. Here he's got weak triggers. He makes the choice not to take the trade. Great job, Pete. Pete says, I can let it break. I don't have to hope it breaks. I can let it break. Nicely done, Pete. All right. Next. Dun, 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 dun. Bob be the man. Oh, Bob. Oh, Bob. Want to talk about some of the best annotated charts in the business. Good morning, Wayne. Good to see you, man. So, Bob, I have to start. I'm going to read left to right like they taught me in English class. Trade the mid-band until it doesn't work. Guys, this isn't a Nexgen rule. This is a Bob rule. Nexgen, I will mention trade the mid-band until it doesn't work in a strong trending market. When the market has been trading 30 plus bars without a reversal bar, broken a lot of fib areas, then there is a little bit of traditional trading that says trade the mid-band until it doesn't work. If that's all it took, guys, my first hour would be a lot shorter than it is. He has a weak top, but he does have odds favorable momentum. And Bob knows he doesn't have a clear path. Bob says, I don't have a clear path. He says, but you know what? I'm writing a recipe. I'm creating a trading plan. So why I traded? I traded because of the momentum on the large and small charts. Pattern recognition isn't a reason to trade. Describing that pattern is a great way to do it so you know what that pattern recognition is. Mid-band entries with room to profits. And that's exactly what he does. With momentum on two charts, he sells a mid-band, gets out at a fib. Sells a mid-band, back out at the fib. Sells a mid-band, back out at the fib. Sells a mid-band, back out at the fib. Sells a mid-band, takes profits. Guys, there is so much wrong fundamentally with the termination condition side of this. But he knows. He knows that it was there. Bob says, man, with all of this momentum, it's going to be hard to stop it. With a large chart that looks like this, it's going to be trouble. And really, Bob, the only one into the termination condition that didn't fit the rules was the first one. And then it turned into 50-50 trades. Potential to break, because look at the large chart continuing down. So, Bob, I want to beat you up, and I want to tell you, dag nabbit, Bob, your first one, actually, your first two were indeterminations. After that, that thing had the potential to break, and you capitalized on it beautifully. And because you knew that it was only potential, you managed aggressively. And while looking at this, you're like, oh my God, he just traded into blue fibs. Look at that, blue fibs everywhere. His large chart said, baby, we're probably going to break that one. Bob, trade away, but manage assertively. I like this chart, Bob. Nicely done. And your annotations are rad. You do such a good job writing out what you're thinking, what you're doing, where you did it, why you did it, and you remind yourself that you're pretty good at this stuff. Nicely done. And this is the same picture. And I don't know if you meant to double post. You're like, it's a trade that's so nice, I'm going to post it twice. Or maybe, you know what, it's only one and I clicked it twice. That was me. Andy, we're going to save your TV stuff till the end when we start talking about TV. And then Ron says, like the ocean, jumped the gun a little early on this one, got stopped out, and then got back in, kept his head in. And this is cool because he posted in the room, everybody takes losers. Lose the trade. Just don't lose confidence in what you know. Guys, when I was racing motorcycles in a different life, there was an expert racer, a pro, who told me there's two classes. They divide them up. There's novice class and there's expert class. And the expert told me, he goes, Mark, he goes, the difference between an expert and a novice, it's not knowledge base, it's not lap times. He goes, the difference between an expert and a novice is that an expert will have a problem, whether it's a mistake or a malfunction or anything, but their head is back in the game instantly. They know that bobbles happen, that mistakes happen, that things that are going to happen that you don't want to have happen. A novice will be pissed off for an hour and a half about this loss and make bad decisions. An expert will get right back in because the rules are met and take that trade and make that money. Ron, thank you for showing us that everybody loses. It's just a part of the game. It's just a part of the game. Better Dad, are you back? I have no concept of time. Maybe not. All right, we're going to skip Better Dad. Where are my new users? If you're new with me, raise your hand. I want to focus on you and annoy the hell out of you a little bit. Ask you questions. All right, Cav. Not a good top. Small triggers got above the fib. Price pivots and triggers came down like a pair of open scissors. So odds favorable momentum. And then your limit order was at 21.0875. The pullback didn't get you. You chased the price bar like that fish that got off your line when you were just pulling it on board. So you got in a little later than your entry, a little later than you wanted, and that's okay. That happens sometimes. But you ride that momentum all the way down. Beautiful trade, Kev. The difference between an amateur and a professional is an amateur sees an opportunity and thinks about it. A professional seizes the opportunity. I like that, Pete. I like it. Cav, nice short. And sometimes you don't get the entry you wanted. And you know what? Can we turn this into a lesson? Because we're going to run out of them quick. So if I take a trend trade with this look, odds favorable momentum, clear path. My expectation, or we'll do this, my understanding is that trade is more likely to hit the fib below than retrace against those advantages. This is one of the things that happens when you begin to trust your pattern, guys, is you start saying, with this look on the large chart, with that level of momentum, with nothing in the way, my expectation, my understanding is that it's more likely to hit this fib than it is to just arbitrarily reverse and go back up. So even though Cav wanted to get in up here, Cav says, I'm just jumping in mid-expectation. Sounds good, Todd. Take care, man. Because I still expect it to go to the fib. He just got in a little late, guys. And when you say to yourself, this is the high probability trend trade, these advantages are in play. If I take an entry, this is where I expect things to go. Sometimes a late entry isn't that bad. You can still find a way to capitalize. And Cav, you did a really nice job on that one. All right, boom, 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 boom. It's the Better Dad Show. Let's see what we have, Better Dad. Weak bottom, odds favorable momentum, clear path. Yes on both. I love it. Look at that look, guys. Entry 2 ticks above the mid band, inside of triggers. Profit target 100 bucks, and they get you break even, right? Initial stop was down here. Better Dad, this is absolutely perfect. This is 100% KISS plan entry, 100% KISS plan management. Are you bummed about the 100 bucks? That's the one thing. Sometimes people are like, man, I only made 100 bucks. I think that the execution is absolutely beautiful. And I'm going to go to the client trade section and I'm going to scroll to the bottom because Better Dad, it is so well annotated. It's such a good trade. I'm not even worried about the results. I'm not worried about the fact that you got stopped out. I want people to be able to come up and see this and talk about it. and say, you know what, better dad, had the perfect high probability trend trade. And now the rest of you can come back and look at that pattern, because guys, that's the one, that's the easy money. Mid-band is a termination condition more than a full bar away. So better dad, more than a full bar away from what? Or let's do this. Let's define a termination condition. What's the first thing that has to happen to define a termination condition, better dad? Do you remember that simple little recipe that we talk about every morning over and over and over again? There's two things that you do. The first one is price reaches an area. You're not even close. You're in Alabama and you believe that you're in Miami. So do you see how price never even got close? So the mid-band is just a squiggly line in the distance. I love the recognition of the triggers though. When the large triggers aren't following, price is likely to snap back. The challenge is that you entered against everything. You entered against trend, you entered against triggers, you entered against momentum, and you didn't even do it from an area. So if that were at the mid-band, cool. But look at what you're against, and you're literally coming from the middle of nowhere. This is very aggressive. What if it actually went to the mid-band, right? What if it went to the fib? You have absolutely no indication that this market wants to go down, and I think you probably got lucky. Does that make sense? Is that fair feedback? This is the one where you saw someone in the room take that gap theory and capitalize on it. And we misunderstood a couple lessons here. And that's okay. It's great conversation though. So let me give you a little, because I like this trade and I love your awareness of the gap theory. If price, whoops, wrong one. Let's just turn everything into a lesson today. If price had reached that mid-band, better dad, and these large triggers were still down here, that gives you a fighting chance getting a close below the small triggers, getting a close to the other side of that odds favorable momentum. That gives you a more of a fighting chance, and it also gives you a place to put your stop. Does that make sense? If you're gonna fight trend, if you're gonna fight momentum, if you're gonna fight direction, all those things, give yourself some sort of small chart advantage. Otherwise, you're more likely to just get run right over. I get over eager too after waiting. I get it. And then you have momentum. And hey, look at that. It hit the mid-band, which is a termination condition, and it closed the gap to the triggers. That's the one. There's your entry to get back to the triggers. See it? That's pretty cool. There's the actual one. And then you get in at 74, which is way up here. And you are trading into a termination condition. And then it stops you out. This is that decision-making zone where you have a termination, you can't go short, you're not sure if you're going to go long, and you just don't have any areas to really trade from, and you got caught up in the mess in between. And then when everything says down with momentum, you get in and you go down with momentum. Lesson, still into the mid-band, but it's not. That's okay. Instead of doing nothing, you chose to take a lesson from it, better dad. So your mid-band was down here at 85. Well, Better Dad, do planes fly over your house? Of course they do. Are you worried about them crashing through the roof? Because it could happen. It could happen. Ask Richie Valens. But let me show you something. Your midband was down here. You're not trading into the midband. There's a definite language lesson here. If I trade into the midband, it means the midband was hit. If I trade to the midband, midband not hit yet, it's my target. Does that make sense? The same way you didn't trade into the blue fib, you were trading to the blue fib. This costs people money. This gives you beautiful targets, and I think you did a great job of it. You had momentum, you had path, you had room to trouble, and you capitalized awesome on it. Nicely done. Does that make sense? And then once it hits the mid band, that's when that gap theory says, whoa, pump the brakes, Better Dad. And you did. You pumped the brakes. Great job, dude. But you didn't let the bar close. You jumped the gun a little bit. We do that sometimes. Usually when I do that, it goes all the way up to the large triggers and gets me. But I'm glad you got away with one because you did have momentum. You did have path, and it hadn't hit that area yet. You traded to an area, not into an area. And then momentum and path. Jump the fudge in. All right, faster market, more slippage, worked out today. But when rocking and rolling, sit on thumbs. Time can be a disadvantage in this too if wrong fills and not enough time to change entries. So, not the high probability trend trade entry. 81.75, 90. Is that 91.75? 91.75. Oh, it was. Both of these were the high probability trend trade entry. And then your stop was break even. Did you get, okay, so you hit your target, out break even. It's hard, this was fast. So both of these were at the mid band. It's just so fast it looks weird. So perfect entry, quick profits, break even, awesome. And then we go back to that, the difference between an amateur and a professional, Better Dad. An amateur is calling their wife and saying, oh my gosh, I just made $100. I'm so awesome. You should see me. Children should sing songs about me. You said, wait a minute, my rules are still met. I still have momentum and path. I still have a mid-band inside of triggers. Let me get back in and make the rest of that money. Better Dad, putting on a clinic today. Really well done. And you know what this tells me? When you're able to execute an entry and a profit and management, and you're able to execute it within 12 seconds in a trade, do you know what that tells me, Better Dad? It tells me that you know your rules. It tells me that you believe in your rules. It tells me that they're becoming second nature and you can execute even under pressure. Dude, that's amazing. That is maturity. So we tend to not celebrate our own victories. I'm going to celebrate the hell out of this victory with you because, guys, that takes some time. That takes some trust. It takes some study. And it means that you know your rules well enough to execute them quickly. Better Dad, that is everything we've ever hoped for. All right, let's see. Meant to be 50-50, but from a weak top and with divergence, straight from the hopium den. Use the freaking checklist. I love it. It's the second trade, right? So what happens on the second trade? On the second trade, you start to incorporate what you know from the first trade, and sometimes you confuse it. Better Dad, have you heard the story of the 30-day stupid yet? All right, I'm going to share this with you guys. I love this story because I think we all relate to it. When I was in my previous career, I worked for a restaurant. And my job within that restaurant before I became the GM was what they called a first assist. It was assistant GM. But my job within that company was to train people, to train up and coming managers, brand new managers. So as the company expanded across the United States, down in the Southeast and stuff, they would fly their managers to me because systems and routines was my specialty. I'm sure you guys find that hard to believe. And everybody that showed up to my store to become a manager for this company was given a checklist. And the checklist was a detailed list of where they needed to be, when they needed to be there, and then more importantly, outside of the checklist, we talked about the whys. Why do I need you there? Why do you need to do this? Well, everybody that came to me for their first 30 days was a badass, was a rock star. This company couldn't believe that they got such amazing people. And then right around 30 days, we all hit it, guys. Everybody hits it. It's what I call the 30-day stupid. And it's where you believe that you are so freaking smart that you don't have to look at a checklist anymore. Because what have you had? You've had 30 days of success, 30 days of wins, 30 days of really just making the market bend to your every will. But it wasn't you. It was your rules. It was your pattern. And that 30-day stupid is when we start making mistakes, where we stop using checklists, where we begin to say, I'm such a good chart reader, I'll trade my reads instead of the patterns that have been proven to win more than they lose. And that's where things like this happen. That's where really late entries, breaking rules, and they'll give them to you every now and then, and you'll get lucky every now and then. But the reality is more often than not, you're putting yourself in a position to lose long term. So better dad, congratulations, you're human. And I'm glad you hit your targets, but that's a rough look, right? That's a rough look. No worries. Tell him I said hi. Good trading though, better dad. Great job. But that 30-day stupid, it's a real phenomenon. And I know you're not supposed to say stupid, but you know what? We're not in kindergarten. So work through it. All right, Cav, we got a couple more. Ooh, the triple shot coming from Cav. 1, 2, 3. Price stopped in the middle of nowhere. Yep, but it gave you the best momentum ever. And with that momentum, 21.1197, you are trading up. And when it snaps back, you go long. Didn't quite make your entry area. You got a little lucky trading into the one-to-ones, but this one had the potential to break. This one-to-one gave you the bounce you needed, Cav, to get you to your entry. And then getting out before trouble. I mean, nice job. Great trade. Momentum, 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 momentum. Have I mentioned momentum is pretty awesome? And then Cav pulling a fast one on the market. So guys, there's a termination condition. This termination condition gets those small triggers screaming up. Large triggers are still trying to catch up. You'll notice that Cav bought a pullback to these small triggers, and it looks like a pullback to the large triggers over here. This is a trade that Nexgen started teaching in 2004, guys. When a Fibonacci area holds on your large chart, when the small triggers roll, buy the pullback to the small triggers. That's what it looks like on a small chart. Cav did it excellently. Momentum, why to trade NASDAQ? Momentum on the NASDAQ is hard to stop. And when you couple it with a clear path, Anna, it's good. The flip side is if you break rules on the NASDAQ, you are typically punished quickly and without mercy. Notice that he has a clear path. He's coming from a termination. Everything says up. Mid-band's not a termination because the large triggers aren't a full bar away. And he finds a way to capitalize. And that's one of the great things about the NASDAQ is there's more opportunity. You still have to be patient, but it moves so much that there is opportunity there. And then Cav, just bonus, I don't know if you caught this. Those small triggers, they just weren't even coming down for you, which helped on the move up. Good stuff, man. And then with odds favorable, momentum, and a clear path, pull back to support inside of triggers. And it's easy peasy. Easy peasy. Great trades. All right, Steve Diego. We got 4. 1, 2, 3, 4. Let's see what you're doing, my friend. Again, you just don't tell me why you're doing it. Next-gen momentum trade. So you had momentum. Not the potential to break over here, but with the momentum there, the momentum here, you buy a snapback to the 1-to-1s, and you get out up here. And the only thing I can say about this one, Steve, is that the rules say let the small triggers break the area. But with that momentum, with this momentum, you have room to get up to the fibs, and you take beautiful advantage of it. Momentum, get above the decision-making points, take it off. Great job, Steve. I like it. Momentum and path. You didn't get in on the way up. You decide to get in on the way down. I love it. And then when the third divergence prints, you're out. Not a big winner. Great trade, though. You had momentum. You had path. Beautiful entry. And then they just had other plans. Oh, and you got paid? I like the dots. I really do. And then break even on the second. Do you guys see it? Momentum and path leads the way. He doesn't get in on the way up because this is NASDAQ, and those NASDAQ triggers can act as support the same way they did there. He gets in on the way down, and he gets paid. Momentum and path, he gets paid. Momentum and path, he gets paid. I'll be damned. There may be something to this, guys. With the divergence, you take the confirmation bar. With the confirmation bar, you get paid twice. So the one thing, actually, your areas are outside of the triggers too. So great job on the confirmation. Shorted earlier here, thinking divergence line extended to the entry point, lost focus. Oh, that happens. Nice job, Steve. And then momentum and path. All right, so I have to address it. I have to address it. We're going to go through and we're going to talk about the entry rules, guys. Reversal bar starts the pullback. Large and synthetic triggers define where the retracement is most likely to occur. Areas inside of triggers define your entry. Once you get to the wrong side of the triggers, you don't know if, when, or where that market's going to continue down. Does that make sense, everybody? This is rule number 3, 100%. Steve, if you're gonna take a short, another entry after, that's the one that's less likely to just run you right over. Because once they blow through these triggers, especially with those small triggers up this strong, that market's not going down until it gets to the other side of those triggers. This will help you buy a little patience. This will help you avoid that loser on the NASDAQ. Nice trading. Hope it made sense. Cav, here's your strong trending market. Everything says up. You get above the fibs and buy the pullback to the fibs and make money. Nice job. Instead of trading into the fibs, you trade from the fibs. What a great concept. Nicely done, Cav. Whoa, directly into the old termination condition. Great entry, and you manage before you get back to the termination condition. Sometimes if the path isn't clear, with all that momentum, you can trade back to the path. Other times you trade into termination conditions, and you get run over instantly. Do you see it? Directly into the termination condition, didn't work. Directly into the termination condition, got away with one. So guys, what you have to ask yourself, and Cav has gone through this process, and Cav has asked himself these questions, but for you newer people, I want you to see something. I'm going to do this, Cav. I'm going to steal some of your pictures. So, into term worked. Didn't work. What's the difference? Both had momentum. Both were coming from a strong bottom. Both had the same entry. They're exactly identical. Does that make sense, everybody? These looks are exactly the same, just flipped upside down. Nope, Estefania, the triggers are strong on both. I'm about to give you guys the keys to the kingdom on being a day trader. Are you ready? Trading isn't about the one trade. It's about, if I take this look 100 times, does it win? We'll say 75. That's what we call an edge or an advantage. So what happens is you take this trade and you get away with it and you say to yourself, yes, I'm going to do this because that trade won. And then you take the same trade and they whip your ass. Guys, trading isn't the one that wins or the one that loses. In order to have an edge, you have to have a sample. You have to have 20, 30, 40 pictures of the exact same condition, and you have to be able to say to yourself, this is a look that wins more than it loses. This is a look that wins more than it loses. And then your job as a day trader is to trade the patterns that can be proven to win more than they lose. And Cab, I think this is an amazing lesson because this says don't ever trade into a termination condition. This says always trade into a termination condition. Which one's right? Well, you have to go back to your charts and you have to go back and take those pictures and you have to say to yourself, well, that one didn't break and that one didn't break and that one created a big ugly bounce and so did that one and that one stopped the market, but that one broke. And your brain's going to focus on the one that broke. Their termination stopped it. Termination, termination. I mean, my goodness, termination. Termination, termination, termination. They do break, but they don't break more than they don't. So as you newer users go through this, and Cav, this was such a great example because we've got the exact same look going both directions. It's okay, that happens sometimes. Go take a break. This class is designed to teach you a pattern that wins more than it loses. Cav knew that he was going into a termination condition. Cav made the decision to go into a termination condition. Didn't work out. When you know what you're up against, you can make that decision. And when you've made that decision, you can at least manage aggressively. So Cav, great trading. On a whole, great trading. But there was such a good lesson there. And then Cav's just going to back up the lesson. And he's going to say, when I have momentum and path, this is when life is easy. And there it is. There's the easy life. You can hope stuff breaks or you can let it break, right? You can hope weak triggers push the market or you can wait for momentum. And Cav, expert trading, easy profits. And this is why I don't beat you guys up for trading into termination conditions. It may be a part of your plan. But if you're the brand new user, you have to know you're going to lose those more than you win them. If you just go back and do the math. Morgan got bamboozled. Did you get flim-flammed as well? So, strong top, odds favorable 50-50. One divergence is horrible. Two divergence is detrimental. Three divergences is 32 flavors of suck, guys. Morgan, I don't know why you went short on this one after a pivot stop out on a 50-50. You were able to make money. I love it. You got out break even. Those are the hard trades, guys. All right. So you took the HVA. Okay. Right on. So just remember your market flow chart, and your market flow chart is a confirmation chart. When these charts say go, this helps a little bit. And you took a good one right off the HVA. So one of the things is trust, right? Why did you take the short off the HVA? You took the short off the HVA because this thing was screaming with the potential to break. They never came for you. They never broke that HVA. And this is where, I don't know, is what you're doing producing results? Let me help you with this one. Okay, then why are you changing? I want everybody to ask themselves this question. If what I'm doing is successful, why am I adding more? Do I need it to hit my goals? Am I bored? Do I just want to do more? None of these are wrong answers. I can't type. Want to do more. So none of these are wrong. Do I need it to hit my goals? Maybe you do need another trade. Maybe your goals are so lofty that you have to find every opportunity. Are you bored? Do you hate the idea of sitting for 90%? So let me find more opportunities. That's okay. For a lot of you guys, that activity keeps you awesome, right? It keeps you sharp because you're focused. Do I just want to do more? I don't need it. I'm not bored. I want to be active, right? Hey, Wayne. So every time you add a trade, Morgan, every time you add a trade, you have to have reasons for entry and exit. You followed your plan, right? 100%? You're good. And that's okay. You only get to trade during class times. I only get to trade outside of class time, so I totally get that. At least you get the good market. But one of the things, and I like it. I love the look. I love the reasoning. I love everything about it. Market flow charts, ladies and gentlemen, are confirmation charts. Market flow charts say, this chart says go, this chart says maybe, I need a tiebreaker. And that was your tiebreaker, and you did it expertly. Yeah, you did it perfect. And then you have to decide which one you're going to trust. Three divergences says no more trades. I think you did it great. I really do. I just know that you're incorporating it, so I just want to talk about it a little bit. When you have an HVA here, an odds favorable momentum here, that's opportunity for days, Morgan, and you nailed it. And I love that you're getting paid, and I love that you're not relying on hope. So I said a lot of stuff that sounded like questioned some things, but the trade is awesome. The trade is awesome, Morgan. You didn't get bamboozled. You followed your plan. Does that make sense? You didn't get bamboozled. They didn't flim-flam you. You weren't speckle-dwarfed. You followed your plan. That's awesome. That's hard to do. Even though the market went down, even though you have feelings of regret and remorse, you followed your plan and you didn't take the next entry because it would have broken your rules. So, gold star, man. Like Ron, took this trade and got run over. What trade is it? Is it the I don't have momentum, it's directly into, oh, I do have momentum, but it's directly into a termination condition. I'll do it anyway and hope for the best. I don't understand how that's like Ron. If you're trading the NASDAQ, Cav, if you're trading the NASDAQ and you fight those small triggers, you're going to get your ass kicked. I can tell you right now, I've blown out 15 accounts doing it. If you Fight these small triggers on the NASDAQ. You're going to get blown out of the water. Just happens. If you get in on the correct side of them, it's easy money. You have a fighting chance. This is the biggest lesson that I ever took from the time I spent trying to learn the NASDAQ. There's 2 NASDAQ entries for the high probability trend trade, or for the trend trade. If you get to your area of entry and the small triggers are less than a full bar away, sitting on your hands and waiting for the close on the other side produces the best results. If you get to your area of entry and the small triggers are a full bar away, get into the entry, because those triggers may act as resistance. A lot of times people make the transition over to the NASDAQ, and you forget that the small chart on the NASDAQ is the large chart on any other market. Guys, and on a 13.2 chart, let's go to a 13.2 chart. On a 13.2 chart, you're not going short against this look. You're like, no way, those triggers have to roll. Give me a fighting chance. This look on your large chart, guys, that's your small chart on the NASDAQ. NASDAQ is a different animal. I don't know what you mean, scale my ATM. The settings? I start with a 28 tick stop loss because it allows me to put my stop where the market shouldn't go. I don't know. On NASDAQ, you got to be willing to give it more room, I think. Each tick is half that it is on crude oil or S&P. So if you're just doing basic ratios, you could try 10 beyond the triggers. Honestly, Morgan, I don't think the triggers are a safe zone on the NASDAQ. I don't think they behave the same way as they do on crude oil. I don't think they behave the same as they do on the S&P. The NASDAQ overruns a lot, which is why that stop gets slaughtered all the time. And it was that slaughtering that got me to where I could start saying, okay, I need something better than a stop loss 5 ticks beyond the triggers. I need to respect these trigger lines, because what happens if I wait for the close below them, I've got a place to put my stop. Does that make sense, Morgan? And there's a million ways to do it. I'm not saying my way is right, but I'm saying that I've put a lot of time and study into that method, and you guys are free to steal it. You guys are free to test it. You guys are free to look at it and to see if it works for you. And I typically don't. Gary, show us some trades. You're trading a totally different methodology, Gary. Your stop loss may not be what somebody needs, right? You manage every trade different. Gary, you trade into, I know, this is Nexgen. This is Nexgen. So if you want to show one of your charts with an entry where your stop would go, that would be great. Because of these advantages, because of what I'm doing here, this is where we're at. But Ale is a completely separate entity. Ale is a teaching firm that uses Nexgen software. That's where the relationship comes in. I don't teach Ale in this room. You guys have to pay for that. And it's amazing. I've studied it. It's awesome. But it's difficult to say, oh yeah, I use the Ale stuff, right? I use the Jim Bob stochastics that I learned in 1973 for this trade. What does that have to do with Nexgen? Cool, 30. If 30 works for you, awesome. Odds favorable, potential to break. There's your entry. And notice how the small triggers were a full bar away. You take it. It works. Off you go. I love it. Guys, everybody's different. Grandpa always said, if we all did the same thing, if we all liked the same stuff, everybody'd be chasing grandma. Can't have that. So guys, Learn it. 30 ticks is awesome. I love it. It works for you, right? Gives you some wiggle room. You need that on the NASDAQ. I personally don't like to arbitrarily put 30 ticks on a trade if the conditions aren't right. My risk for every trade that I take, guys, is in the place that it's at because of the advantages that I have, not because that's what I'm willing to lose. If that makes sense. 30 is an arbitrary number. It gives it wiggle room, but I'd rather just be in the right trade and know where the market shouldn't go. That's why I teach it like that. They've got to be like I like that. Treat your rules like your favorite recipe. Because if you change your recipe, you change the result of what you're making. Good stuff. All right, guys. That's all the pictures. That's the second hour. What does the live market say? The live market says price reached a midband. Large sugars are a full bar away. So the midband's a termination condition. Price reached yellow 1-to-1s. The triggers are above it. The yellow 1-to-1s are a termination condition. Price reached resistance. Only the smalls are below, not the large. Resistance doesn't even have the potential to break because my large triggers aren't wide in the direction of the trade. I don't even have momentum. I have 1, 2, 3, 4 reasons that tell me my rules aren't meant for a high probability trend trade. If you are choosing to take a trade because of a termination condition, because the small triggers rolled, you already missed your entry. Good stuff. All right, guys, I'm going to come back in a minute. When I come back, and Gary, I'm not knocking ale. I love it. I love ale. I love everything about Safia and Janesh and what they've done. But for somebody that's trading the S&P or crude oil, these numbers don't mean anything, guys. This is based on his methodology and his trading parameters and his entry rules, and they're not relevant to a trend trade on crude oil. They're not relevant to a trend trade on the S&P. Awesome. Cav, have an amazing afternoon, man. Great trading, great lessons. But the flip side of that is if you take a picture and you say, my plan says with a term and small triggers, but it depends. So, Gary, I understand that. The question was ATM stops on the NASDAQ. For what kind of trade? For what kind of instance? For what kind of entry, right? Because the ATM stops are a number that should be in place where the market should not go, right? So if I take an entry right here, the market, if this trade's going to be successful, it shouldn't go above right here. That's not 30 ticks. If I take this momentum trade, I shouldn't get 2 bars up. That's not 30 ticks. So it depends a lot, is what I'm saying. It depends a lot on the trade that you're taking, right? Because momentum exit rules are going to be different than HVA exit rules, that are going to be different than trend trade rules. And this is one of the things where when I said earlier, and this is a great example of it, you have to know why you'll enter the trade, guys, and the rules are met. And your rules are met for a very specific trade based on very specific advantages. And why you will exit is specific to that trade because those advantages go away. So if you have a trade that is based only on momentum, a loss of momentum isn't going to be 30 ticks. If you have a trade that's based on counter trend trading and small triggers rolling and pulling back to them, your advantage is gone when you get above those triggers. That's probably not 30 ticks. If you're looking for the high probability trend trade and taking that one, and you're in at the areas inside of triggers, well, 30 ticks gives you reaction time to put your stop where the market should not go in that particular trade. And then when you throw NASDAQ into the mix, guys, NASDAQ is batshit crazy. And it overruns areas all the time. And it overruns them excessively and extensively. So 30 ticks may not be a good spot. Maybe you need to use some other measures. And that's where I was going with that, guys. When you know what you're getting into, That's when you start to formulate a management plan. That's when an ATM strategy makes sense. And if you just say, you know what, it's the NASDAQ, I'm going to give it 50 ticks and then put it where the market should not go, that's great. But 30 is not a safe number. Depends on the trade. If you're in on this momentum trade, 30 ticks is a ridiculous loss. If you're in on the trend trade and you've already gotten the reversal bar, 30 ticks might be excessive. You may be able to reduce. So that's kind of where I'm going. If you got into the mid band here and it started up, hell, 2 ticks might be appropriate and then have to take a re-entry. I hope that made sense. All right, I'm going to come back, and when I come back, we're going to talk about some TradingView stuff. I'm more than happy to keep going through Nexgen stuff. Guys, remember, please, please, please remember, I don't work. Estefania, did I get yours? Did I miss yours? Did I give someone else credit for yours? I saw you posted. Ah. No, don't ever let me get away with not getting it. Open triggers, green background. And what's the challenge here? Okay, divergence, right? So into a termination condition, but with a lot of strength. If you take the entry at the area inside of triggers, you have to manage assertively. Does that make sense? And it did because of the termination condition. That's the lesson that I want you to get out of this one. Awesome. Good stuff. It doesn't mean that you can't take a shot every now and then. All right, possible good entry with odds favorable. Green background, small triggers above the large, room for profit. So what you have here, Estefania, sorry, I wanted to get you before you left. This isn't momentum because the large triggers are down and the small triggers are up. It's great recognition on the pullback here, but it's not a rules-based trade. This is your strong triggers when they're both green up and in the direction. This is your strong triggers. What this is kind of hoping the market goes up because it's not going down. Does that make sense? If you are coming from a termination condition, if there was a fib here, I love that entry. But because there's not a fib there, that mid band has a really good shot of stopping forward progress. It just happened to not this time. But when we talk about momentum, awesome. And I think this is just one of the most important things is make sure you remember that the background and the trigger line colors match, and they've got to both be screaming in the direction of the trade with that space, just like that. And what you got was a pretty good transition where it was going from down to up. So that was great recognition, but not odds favorable momentum. Good stuff. I'm sorry I missed those. Guys, if I ever miss your pictures, please let me know. Don't let me get away with that. I never do it intentionally. Never do it intentionally. Okay, now you can say thank you and go enjoy your day. Or you can post more pictures. That works too. Did I miss a run of pictures? Wayne, did you post? You did. I did miss some pictures. No, here we go. I must have got caught in a time warp, guys. Sorry about that. So Wayne, trend trade, odds favorable momentum, disagree. Smalls are inside of the large. Clear path, disagree. Price reached resistance, not one trigger broke through. I don't see momentum or path, Wayne, and I don't even see areas inside of triggers. Would it be fair to me to say that not one rule for the high probability trend trade is met on this particular chart? Now let's go to the next side of that thing. The trend is up, every indicator is up. The trend is up, every indicator is up. The trend is up, almost every indicator is up. And you don't just arbitrarily jump in hoping the trend continues. You wait for the market to continue in the direction of the trend. Is it a high probability trend trade? Absolutely not. Is it a trend trade? 100%. And one of the things, Wayne, you see this a lot, and that was a spike. But when everything is cranking and you're outside of these outer bands, have you noticed that they can behave as support when everything says up? I think I pointed that out, but you had to go build a car. I see that a lot. I love the trade. I can't say that you had a clear path or odds favorable. You had room to get back, hoping it makes it. So good trade, man. I like it. It's outside of the norm, but it's really well executed. Weak top, we're getting that separation, those strong triggers. These say strong down, these say strong down, these say strong down. And Wayne says, hell, with strong down everywhere, I should probably go down with it. Nicely done. I mean, just perfect. Perfect execution. And everything says up, strong trending. You haven't reached the area, you cleared the previous. Everything is strong here. Zipping over here. Let's make some money, right? And then Wayne, no reason to give it back into a fib. I firmly believe that. No reason to give it back into a fib. Nicely done, though. Everything says up, the path is clear, and you find a way to get capitalized, how to make some money. And then, let me figure out what you did. The market pulls back to support. Not sure what to call this one in the moment. Bought off the HVA, got lucky. You didn't buy off of the HVA. Oh, you traded into the HVA. So true story, Wayne. You went long directly into the short trade off the HVA. But do you know why it worked? We're going to reverse engineer a little bit, and you'll like this. I think you'll like this. So termination, pink HVA, and the HVA trader, the high volume area trader, Wayne, says that's my short. And they ignore that rule number 2 for an HVA is don't trade into a termination condition. So what you really have, and you're going to like this, is you have a termination condition, and you have a termination condition, and you've got the fib over here. When price reaches support, your large triggers don't blink. They're screaming up. Your small triggers never even get below the large. And look at your range chart. Up, up, up. So over here, you get divergence right from the trouble area. The small triggers roll. You catch it on the way up. And all you're doing is you're going from a large chart termination with every trigger above it. You're using the market flow chart to give you that quick zip. And you're on the correct side of those small triggers all the way up to Targetville. I don't know what to call this trade either, Wayne, but I sure do like it. It's a termination, letting the small chart show change, using the market flow chart to confirm it a little bit, and it's just giddy up to the upside. Does that make sense? And the rules for the short aren't true right here because of this right here. It's an awesome chart read, dude. You got your reaction off of resistance. It traded directly to where the market could stop it, and it did. So you catch it on the way back up. Dude, that's really a nice trade, to be honest with you. I like it. All right, guys, I'm going to take a minute. I'm going to pull TradingView over here. That's the NASDAQ right now. Figure out where it's trading. I'll spread that out so it's a little more legible. When I come back, I'm going to start talking about TradingView a little bit, guys. So the way I'm doing it right now is we're going to talk about the indicators. They're nothing new. And I'm going to introduce you to the 3 trades that are on the plan. I'm going to give you the plan. I'm going to give you my own personal study that's going with it. We've got NASDAQ. I've got the S&P over here. Try and make them all legible. When you don't look at them for a few hours, they get a little out of sorts. And I've also got crude oil. We're going to talk about a trend trade. We're going to talk about a high volume area trade. We're going to talk about a momentum trade. I'm going to introduce you to the indicators. Guys, TradingView isn't mandatory for you. If you're happy on NinjaTrader doing what you're doing, do it. Have fun. If you want to use Nexgen's prop firm, you're going to have to make that transition. And one of the ways that John has made the transition easier, Gary, there is no ATM on TradingView. You have to put your stops and targets in place on your own. There is no predetermined ATM. So when you enter a market, you've got to put your stop where you want it. You got to put your profit target where you want it. It takes a half a second. You can hit trade, and over here you can say, well, I'll take my profits here and I'll take my stop here, and it'll show it to you, and then you can buy it and have them in place like that. So if you're anticipating, or you can just drag them. Does that make sense? But there's not a traditional ATM like you're accustomed to on NinjaTrader that I'm aware of. So as we get into the final hour, guys, there's two things I want to remind you of. One, I don't work for TradingView. So if you ask me TradingView questions, I might stumble and fumble a little bit, but there is a knowledge base specifically for all of you TradingView people. There's 60 million users, guys, and these are the most commonly asked questions. Feel free to look. Feel free to ask in the room. I'll do my best to get the answer for you. We may just search this together. My job is, and always has been, to help you guys learn to read indicators, to help you guys find trade with the software provided. So to help you guys transition over to TradingView if you choose to, John Novak has built workspaces. He's built workspaces. He's paid programmers to make indicators that look like what you're used to. And he and I have worked extensively over the last 4 or 5 months to give you rules for 3 different trades that you can use on TradingView with your understanding of Nexgen indicators. And that's what we're going to start talking about a little bit. So I am going to take a walk and stretch my legs. I'll be back in a couple minutes. When I come back, we'll start talking about what we see. So if you have questions, drop them in the room. I'll do my best to answer them, guys. All the basic stuff I'm getting really pretty good at. And then I've got people in here that are helping me a lot too, because you're more experienced with it than I am. I appreciate that. Type in as much as you want. I'll see you guys in about 3 or 4 minutes. I will be recording this. Please ask questions. Ask questions. But I want to do this. This is what I put together. This is to ease your troubled mind. Those of you that are making this transition, if you are anything like me, and God help you if you are, I hate change, guys. I really do. I always have. I have been resistant to change my entire life. Fight the system. Um, so one of the things I did is when John created all these indicators that look like the Nexgen indicators, well, they are the Nexgen indicators, but the indicators that you're accustomed to, I broke them down individually to remind you guys, this is nothing new. These aren't new concepts. So you're going to have small triggers and you're going to have large triggers, and they look just like you've been looking at them for as long as you've been with Nexgen. You're going to have divergence lines, that loss of momentum. It's going to be magenta at a high. It's going to be cyan at a low. It can stop the market, right? These are areas that you trade to, not into, because they can create bounces. It's just a loss of momentum. It's everything that I've been teaching for the last 5.5 years. Nextgen's been teaching for 20. There's one-to-ones. There are the yellow one-to-ones. Those are the big swings. There's the pink one-to-ones. Those are the smaller swings. One-to-ones can be traded to, they can be traded from, they can act as support, they can act as resistance. Everything very familiar. There's the mid-band. We all know and love the mid-band. If price is above it, it's green. It can behave as support. If it is below it, it's resistance. It can act as resistance. It's magenta. And then the one thing that's going to be new to a lot of you guys, let me make this a little bit bigger, are these outer bands, the white dots. Looks just like the mid-band. Do you see it? So these are outside mid-bands is the easiest way to think of it. They are points of exhaustion, guys. When the market is trending, when the moving averages are doing their thing, and they typically go up and down, every now and then the market's going to get way out of sorts. These are your breakouts. These are your big runs. When they hit mid-band or outer bands, very often profits are being taken, guys, and you're going to see it. You'll see the consolidation, the fight, just like it was an area and maybe a reversal. And like we spoke with Wayne, when the market's really trending hard, these can behave as support and resistance if the market finds its way outside of those exhaustion points. So the outer band may be a new concept for you. And then zones are going to be new for everybody. And everybody in Nexgen that I've worked with is saying, well, they're like fibs, right? Well, they're like fibs. They can behave as support. They can behave as resistance. You probably don't want to trade into them. You'll have a higher chance of success trading away from them instead of directly into them. But they are not fibs. They are zones. They are supply and demand. And this is where when Gary discusses that ale class that he takes, it's a part of it. So the outer band is not chart prime, Jill. Let me do that. The outer band is one of the Nexgen indicators. Chart prime is supply and demand zones. So once you put your mid band on, the trend channels, let me see what it looks like. It is trigger lines, T3 bands. So it's the T3 bands indicator. That's the one that gives you the mid band and the outer bands. Right there. So if I take it off, boom, no mid band, no outer band. So you can go to your indicators. Under invite only, you're going to see T3 trend bands. And if you click on it one time, it'll drop them back into the mix. Was that it? That was your zones. And guys, that's the complete workspace. The complete workspace is going to have supply and demand zones. It's going to have one-to-ones. It's going to have the T3 trigger lines. It's going to have the bands. And you're going to use these all together, and I'm going to give you a plan. I'm going to drop it in there. I'm going to give you a spreadsheet with a lot of pictures, checklists for entry, and then you'll be good to go. So under the chart prime, you've got, it gives you 1, 2, 3, 4, 5 of them. On my chart, Steve, I have the Market Dynamics Pro and I have the Market Oracle Pro. So these are the two that John has worked into the template, the workspace. There, it's the word I'm looking for. So when you download the workspace or when you copy the workspace from the Nexgen site, it's going to have all this on there. And it's going to have 8 over here, 7 over here, because your 1 minute is going to include market flow. And market flow is going to give you the ability to see those HVA lines, those big green lines, these magenta lines, and these are going to show up in the plan. These are going to show up in the HVA trade. These are going to show up also in the momentum trade. It's another place where you can capitalize on that advantage of momentum using these lines the way Morgan did in a trade earlier when his large chart was screaming down and he sold the pink line. And there's a plan, a momentum plan that's going to allow you to do that as well. So Steve, I like to give you guys pictures. I don't know if you use them, but these are the two that are a part of the workspace. I guess I shouldn't cover the name, huh? There you go. So the workspaces. Here's the link. You're going to have to scroll down. John has designed all of these for you. They're using the indicators that are provided. Guys, when you bought software, you paid for the indicators. So everything that that I just talked about, let me, I hope they fixed the page. Yes, they did. Good. The indicators for TradingView. The monthly subscription for those guys, just like the Nexgen indicators, right? It's $199 a month. You have a license. If you've purchased the Nexgen software, you get that for free, 100%. So don't worry about it. The one thing that you won't get for free is Chart Prime. Chart Prime are those zones that if you go through, if you pay yearly, it's pretty cheap. If you pay monthly, it's about 67. I think they typically have, there you go, 20% off code. These are the supply and demand zones that you see on my chart. If you don't want to pay for them, and that's up to you, right? Can't make you. There's a free version. Haven't found them to be as accurate, especially on the smaller chart. But there's one called Algo Alpha, supply demand zones. You'll want to get that. You'll want to type that into the indicators. Get it on your charts. Have these supply and demand zones because you don't have the advantage of Fibonacci on these charts the way you're accustomed to. So once you have your zones all in, guys, you can go through and start playing. Back this up. There are workspaces for NASDAQ, S&P, crude oil, and gold. You can build more beyond that if you want, guys. You can change your charts any way you want. You can change time frames. You can change bars. Doesn't matter what you do. But the way I'm teaching these trades is in this setup, the one from the workspaces. So I'm also going to give you the TradingView plan. Here it is right there. In this TradingView plan, let me open it up. It talks about the support and zones generated using the indicator. There's even a link to it if you need it. NASDAQ futures, all the different things. He's even got Bitcoin and Ethereum trading spaces for you guys that like crypto. A little bit on the role of the charts, guys. So the 15-minute is your roadmap, very much the way the large chart with NinjaTrader is your broad stroke of the brush. You're going to use it for key targets, turning points, terminations. Trigger lines on this will define the direction and overall momentum of the market the same way it does on the other stuff. Both triggers in the same direction is best. Lonnie, so that goes back. It's best. When you've got strong triggers on a 15-minute chart, oh, that's my big move look. And in order to fight those, you need that smaller chart to go the other direction. Your 1 minute with market flow, this defines the immediate strength of the market. This defines entry points. You're going to look for pullbacks into zones that have been broken and retested, guys. And John gives you a lot of examples of both. The entries in this particular trading plan, entries are taken from mid bands for trend trades, from HVA lines, and from termination zones for that momentum trade, and then from HVA lines for just momentum. So the trend trade, there's your checklist. For the HVA trade, there's your checklist. For the momentum trade, there's your checklist. You're going to realize that there's only 3 things on each checklist. So we're going to go through and we're going to talk about those 3 rules, guys. If you have a question, please interrupt me. I don't mind. I'm also going to give you this, guys. I've been working on this. This is like the same as the spreadsheet that I give out at the very beginning of the day every day. This is a place to put your trades. There we go. HVA trades, and just start snapping pictures. Trend trades, start snapping pictures. Momentum trades, start snapping pictures. As you learn to manage, take pictures, guys. Nothing's changed. The more pictures you take, the quicker you're going to get to where you want to be. Thanks, Andy. And I love to show this, especially as much as I've been doing lately. Guys, I'm up to 3280. It seems like every time I show this, I'm up 100 or 200 pictures. Today is the 22nd. My pictures from the 21st started right here. There's 9 pictures. 9 pictures per line. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9. I took over 80 pictures yesterday. Guys, focusing on management, focusing on when to hold, where to put stops, what I'm doing, guys. I'm constantly taking pictures and building my plan and trying to make it better and trying to manage it better. And you're right, Andy. If it's hard not to find success when you put that much work into something. So Steve Diego, am I using the large Nexgen charts, i.e. 34.5, NASDAQ 13.2, crude off to the side? I am in my personal trading, Steve. I'm using both. Do you need both? No. Is it a lot for some people? Yes. But you can. So if I wanted to, I could open up my trading view, right? And then I could go to my NASDAQ chart, and we're just using NASDAQ as an example here. And once this loads, so Steve, this is something that you could do. I execute on NinjaTrader. I also execute on, if you took NinjaTrader away from me today, I would have no problem with it. It wouldn't faze me a bit. But you could, Steve, you could take your chart and say, okay, I'm going to have resistance at 21,348 and open up TradingView and say, okay, I'm going to draw a line at 21,348. And now I'm going to be aware of that line. That's my Nexgen Fibonacci level. So you could do that. Absolutely, you could do that. Or you could even just make it smaller and run it off to the side so you see the levels. Totally up to you. In my own personal trading, so like when I'm playing with NinjaTrader, that's what I'll do. I'll look for my odds favorable momentum. I'll look for my clear path. Whoops. And then I'll look over to TradingView and make sure I'm not trading into a supply and demand zone. So you'll find your own way. The plan that I'm teaching, the one that I'm about to discuss and put in front of you, has nothing to do with NinjaTrader at all. Nothing to do with NinjaTrader at all. It's a trading view plan. But if you guys have NinjaTrader up and you want to use those fibs, use those fibs. You can draw them in. Totally up to you. I hope that answered the question. You'll find your way, guys. I don't think you need it. I think TradingView is enough. Personally, I believe TradingView is enough. I believe you can find success on it. I believe there's nothing wrong with NinjaTrader except for the occasional crash. You can find success with it. Nope, you have to purchase real-time data, Nanda. I pay $7.50 a month for it. You're welcome. You would put your stops at 200. So if I entered the market, 2 contracts, better dad, I would take my profit target and I would go to wherever $100 is, right? And then I would have to go to 1 contract. And since I bought, I would have to sell one at 100 and then I would have one at 200. And that's how you would have to do it on TV. So my first target would be at 100. My second target would be at 200. And that would be it. You're welcome. It takes a minute. It takes a minute. It takes a minute just to get through the mechanics. The same way you have to get through the mechanics on anything, guys. So great question there. I like that. You clicked buy instead of the snag it click fixture. Andy, I've done that too. I've gone to minimize my charts and ended up in a trade. It happens. So it's easy. Cisco, if you just click on a chart, it's stuck. When you say switch them, why would you want to switch them? So you want your workspace to be 1 minute, 15 minute? Okay. It is on the right as we speak. Let's see. If I do that, it gives me just the 15. If I go back to 2, it puts them in this place. Let's see if we can grab it. That pulls out just the 1. One thing you can do too, this is where Cisco, where I'm like, oh shoot, I don't know the answer. Let me show you what I would do. I would go to my 15-minute chart and I would make it 1 minute. And I would go to my 1 minute chart, I'd click on it, come over here, and I would make it 15 minute. And that's like the easiest thing that I think you could do. And the only thing that you would have to remember is that on your 15-minute chart, you don't need market flow. And on your 1 minute chart, you do. I think that might be the easiest way to do it. And now I'm back to where I was. Just change the time interval. I don't know that you can, I guess you could take it, right click, move chart, vertical chart template, maybe. Yeah, I'm not sure. That's what I would do. So there's your solution that may not be the most effective solution. If you type that same question in here, you might get a more, a better answer. But for me, sometimes I just go through the path of least resistance. For me, just change the time frames. And then make sure that your 1 minute has market flow and you don't need it on the 15. So hopefully that's helpful. I am too. We all are, Cisco. That's the beauty of it, is everybody has been on day 1 at some point. Everyone was new at some point. I'm still not a TradingView expert, but I've gotten to the point to where I can navigate it enough to be confident, right? But if you guys ask me to fix a problem that I haven't had yet, I don't know how to do it. So when you open a second window, do you see this one right here, layout setup? This gives you all of your options, 1 window, 2 window, 3, 4, 5. So you can start doing things like that. And then you can always go back to that two contract, or to that two window. I think that there's a reluctance for a lot of us. Go through Cisco and try and break everything. And then go back and fix it. So I need to learn how to move a chart. Click it, do this, right? squish it, bring it up. I don't need to do this, but I'm doing it so that if I'm in a trade and something happens, I can get it back. Practice entering the market. Practice moving your stop losses. Practice moving your profit targets. Practice adding a contract and turning it into 2, turning it into 3. Yeah, and I think that once you do that and you go through and you stop worrying about, oh my gosh, I have to be perfect at this. I have to take the perfect trades. I have to manage it perfectly. No, guys, take some time to learn your tools before you really start to work with them. So let's go through real quick and let's do this bad boy and talk about the different trades. The first one is a high volume area trade. And guys, I put this together at 4 in the morning just to give you a basic understanding. Don't use your scroll wheel. See, that's a good trick. This is to give you guys a basic understanding. And if you're familiar with Nexgen, if you've been with me for any amount of time, you know that a high volume area trade is not a new trade. This is a trade that Nexgen has been teaching for as long as I can remember. And it starts with the zone being reached on the 15-minute chart. It starts with a termination condition, guys. Price goes up, hits the zone. That's rule number 1. It relies on the small chart showing you change. So your small chart triggers have to roll. And when they do, you're going to buy or sell a pullback. So rule number 1, this is going to look familiar to everybody. Price reaches an area. Price reaches one-to-ones. Price reaches a zone. Price reaches a mid-band. I don't care what it is. It gets there. Once that happens, you're going to look at your small chart. And your small chart can't be screaming up when you want to go down. Your small triggers must roll and get below the large triggers, guys. This is a smaller chart showing change. This is a small chart showing a difference in the thought process. And typically off of a big area, you're going to get a pretty good push. Your entry's not in there. Your entry is when the buyers come back to retest that HVA line. When the buyers try to push up again, this pink line represents a line in the sand. And that line of the sand is where the highest concentration of sellers were coming off of that termination condition. You're going to sell it. You're going to sell that green line and you're going to ride it to the next area. That's the goal. And it's the same going the other direction. You're going to have a termination condition at a low. And then your small triggers are going to have to roll and you're going to look to buy that green line. So the HVA line is your opportunity to capture the move closest to where the trend ended, closest to where the new trend is beginning. And then after the HVA, when everything is established, it's time for trend trades, guys. And again, I can't stress this enough. It's nothing new. You've all seen this picture, right? I don't even know when it was made, probably a million years ago. Let it hold, sell a pink line, find your trend trade. Let it hold, buy a green line, find your trend trade. So your trend trade needs a clear path. All right, guys, your metaphorical versions is getting a little out of hand. You guys should take that to a private conversation. No areas reached. Once again, don't trade into areas. We've been saying it for years. And then one of the differences that you guys are going to see between TradingView and those 5-1 charts is, guys, the areas on the 1 minute can cause trouble too. So we don't want to trade into areas on either chart. Buy or sell a close on the correct side of the small triggers. Again, those small triggers shouldn't be fun. So rule number 1, everything's going down and you haven't reached anything solid. Rule number 2, make sure that your small chart's doing the same thing. Notice that I don't talk about momentum so much, not the way we would in Nexgen. Guys, if it's going down and there's nothing in the way, look for a trend trade. If it's all going down and you didn't hit an area, look for a trend trade. You're okay, man, no worries. the trend trade entry, the market pulls back to the mid band. Small 1 minute chart. Does everybody see how the fast triggers are up? One of the things that you're going to realize is, he did, Elvis. One of the things you're going to realize, thank you for policing us, is that if you fight these fast triggers, you're going to have problems. They're hard to win against. They really are. So the rules say, let it close on the other side. Let it close right here. And then that's where your trend trade happens. So it hits the mid band and you're patient, and it stays at the mid band and you're patient, and then you get that close below the triggers, and then that's your entry, guys, and that's your trend trade, riding that clear path. So everything off of an area starts with the HVA. And then once that HVA produces the trend going in the next direction, you're going to look for the trend trade. And guys, in between all of those zones, you're going to see momentum trade opportunities. And this is the one where both charts have strong triggers, guys, because it's hard to stop that momentum. And you haven't hit anything on the large chart. So you are literally momentum and path. And you're just going to look for a pullback on the small chart. So I'm just going to go to this one. It's the same picture all the way through. When the large chart has strong triggers, when the small chart has strong triggers, absolutely, Steve. 100%. The same way they are, even if there's not Fibonacci there. There's still areas. Divergence, look at this, still reacts and can stop the market. One-to-ones, still a reaction, can stop the market. So any of those indicators, any of those zones, absolutely, man. You're keeping your eyes on it. This picture doesn't even have the zones on it. But what it does have is two charts with momentum. And then, Steve, you're a rock star at this trade. Let it snap, let it go through, and snap back. Buy that area. Because both charts have momentum. Price gets above trouble. You're going to trade from trouble and ride the momentum up. That's the one you show me in the room every day. That's exactly what this trade is. Two charts with strong triggers. Let it break the zone. Buy or sell the snap back to it. So this can be one-to-ones. This could be a mid-band. This could also be, let's see if we can find one real quick. And this is where I like the HVAs, is it can also be a snapback to that HVA line. So not only is the market going up strong, you also have the highest concentration of buyers giving you something to take that momentum trade from. Does that make sense? This one says short. Strong triggers, breaks through, pulls back, go, go, go. There's your opportunity coming down. So all of these are in. From what I've showed you on NASDAQ, it seems easier to trade on the 15-minute charts. Steve, that's a decision you're going to have to make. I don't have any entry rules for a 15-minute chart. Now, it seems like you shouldn't fight a 15-minute chart. I would agree with that 100%. If price reaches a zone, it's okay to not go long. If price reaches one-to-ones in a zone, it's okay to not go long. If price retraces all the way to a zone, it's okay to not go short. Yeah, and then enter on the 1 minute. Absolutely. But there's going to be times, Steve, where, let's see if we can find an example. And I may not, where your 15-minute, it's coming off of a zone and everything is up, and you might get trend trade rules met here, even though the 15-minute doesn't look like it's trending up, but it's coming up off of the areas and everything. So I was talking to Jerry yesterday. The colors aren't always going to match. That's one thing that's going to throw you guys off. Um, so you're going to be really rule adherence, and we'll find it, Elvis. I'll get you. And one of the things that the rules say is, let me go back. So like on the trend trade, notice that it doesn't say odds favorable momentum. It says no areas reached. And that's gonna become key. No areas reached, having that clear path. So seems to be going through termination spots. How are you letting the trade continue through the areas? Are we talking about, I want to see if I can get to the picture that so that we're clear. Like right here, you see the pink 1-to-1s? So you've got a termination, you've got odds favorable momentum. Let me see if I can come up with an answer that's going to satisfy. There we go. No zone reached on the 15-minute chart, Elvis. That's the first rule. Both charts must have strong triggers. So if you're following the plan, if you're following the rules, because of the large chart strong triggers, you know how strong triggers break things? That was one of the great phrases that were said in the other room. If your large chart has strong triggers, if your small chart has strong triggers, if you have an HVA to support the momentum trade, those pink 1-to-1s aren't as fearful. They don't stress you out so much. Does that make sense? It's because we're letting the large chart have strong triggers and nothing in the way. We're looking to capitalize on that momentum for the large chart move. Great question, though. I'm glad you said that, because it means that I have to go back and look at these as well and make sure that I'm giving you guys good information. And there's the exact same thing. If you have strong triggers on both charts, you're trading this potential to hold rather than this potential to hold, because this one has everything going with it. This one has everything going against it. That's an awesome question, Elvis. Thank you for that. And man, y'all's great questions. What you're doing is you're helping me learn how to teach this even better, because you're giving me these great things to think about. And those are the rules, guys. It's 3 trades. And there's a lot of examples to look at. I would encourage you guys, again, just like every day, I can't force you to. Start taking pictures. Start bringing them to the room. Let's analyze them together. Let's think through these things the way we just did with Elvis, right? Elvis like, but dude, Mark, there's a termination, and embarrassingly, I had to go back and double check. Was I missing something? And that's what's going to help me be more effective for you guys, without a doubt. So let's look at a live market and just see what it says. So the market was up. It hasn't reached anything. It pulled back to the mid-band and gave you a close above. Pulls back to the mid-band and closes. That's a pretty good looking trend trade right there. Let's see if we can put a circle on it. Whoops, that's really big. Maybe I'm doing this on the wrong chart. So guys, there's the area. You're above the zone. Everything's going up. Price pulls back to the mid-band. You get a close on the right side. Pretty good looking trend trade. Wouldn't you agree? Does that make sense? Make the large chart a little bigger. We're on the good side of trouble. We haven't reached the next low level. Pull back, find your mid-band, find your trend trade. And then with everything up and everything up, this zone breaks, it pulls right back to the zone and continues up. There's another good look at being able to use these zones for continuation, breaking and pulling back. This one, it's a 1 minute chart, Elvis. The workspaces are both designed with a 15 minute and a 1 minute. Big slow chart, faster entry chart. The big chart's going to define a lot of trouble. Small chart's going to help you find entries with less risk. So here's an in-the-moment example, guys. Price is directly into resistance, 100%. Directly into that resistance zone. You can see that it reacted. And now the fight is on. We didn't change the basics, Elvis. You're looking at TradingView. You're not looking at NinjaTrader. So what I'm doing is I'm teaching a different platform. Yeah. Elvis, did you know that back in 2004, Nexgen taught with minute charts because Rinkos weren't a thing yet? But you know what's been consistent? Don't trade into areas. Trade with momentum. Use mid bands for trend trades. I'm not teaching anything new. It's just a different bar structure. That's all. It's still the basics. It's still just 3 rules. Yeah. But I think, Elvis, what you just said was how I felt in the beginning as well. I was like, oh my gosh, I have to relearn everything. And the reality is I didn't. And let me show you what I mean, Elvis. I know you showed up a couple minutes late. We're still using triggers. You know triggers, doesn't matter. We're still using divergences. We still have one-to-ones. We still have mid-bands. The only real difference is now you're going to have supply and demand zones as opposed to Fibonacci if you're using TradingView. But if you have NinjaTrader, hell, you can still put your Fibonacci zones in there if you want. We talked about that earlier with Steve. But it's different. It's a different visual. I think so too, Steve. 15 minute and 1 minute. Every workspace. 15 and 1 minute. 15 and 1 minute. 15 and 1 minute. 15 and 1 minute. Same charts. Entry on the small chart. Same as you're accustomed to. Finding entries on the small chart because of what you're seeing in the collective. And then Elvis, there is the whole trading plan right there. It's only 2 charts, that's it. And you know how we are. We wrote instructions. There's all the workspaces pre-built for you, the 2 different charts, how they're used, and a checklist for each of the trades. Even a little bit of example down there. We tend to be pretty thorough. The one thing that I've noticed, and Steve said it, TradingView seems less stressful. There's something about the minute charts. It slows it down. There's something about the minute charts. I think it reduces risk. I find myself with less risk on trades using the minute charts than I do the Renko charts. That's what I've found. And I've also found, and you guys might feel the same way, is that when this 15-minute chart, it's a little bit of consolidation. When this 15-minute chart is absolutely railing in the direction of a trade with nothing in the way, I'm going to show you it. Well, that's it right there. This is a trade I was in yesterday, and this was execution on NinjaTrader, and all it was a trend trade, guys. All it was a trend trade using the large chart, momentum and path. And I let my 15-minute chart straight, absolutely nothing in the way. And I had targets down here. And guys, that's 228 ticks. So one of the advantages, and Steve, I think this is one of the things about it not being stressful, is with a little bit of study, guys, you're going to realize that when this big old 15-minute chart is absolutely screaming, and I want to say that it was somewhere in here where I took it. It does. It gives you some time. It buys you time. The risk tends to be a little less. Here's one of them right here. Large chart up. There's your pullback to the mid-band trend trade. There's your pullback to the zone right at a mid-band with everything up. Little harder to take this entry if you're waiting for the trend trade rules. But with all the triggers up, pull back to the zone, no large chart zones hit. I would have bought this at 256. I would have had a limit order waiting at 256. That's my trade. And then when I get to that HVA line, when I get to that 1 minute zone, that's my first sign of trouble. What a great place to take profits, to take half, to make sure that I don't have any risk on a trade. So, man, I totally get it's new. It feels new, right? Feels like a brand new girlfriend. I got to figure out how to kiss her so she likes it. But she has two lips just like my last girlfriend. It's not that hard. Gonna work through it. All right, guys, what else you want to talk about? I think most of you are probably pretty cool with the indicators. And now you've got to take some time and you've got to learn these rules. And you've got to learn to apply these rules. And you've got to take, it's there, Steve. I don't look at them when I'm teaching. I just lost Discord. Sorry, guys. Hold on one second. I just lost Discord. I'm coming back. Reconnect. Education room. Man, I did this the other day. Speak on stage. There we go. Sorry about that, guys. Let me get my screen back up. My apologies. This is why I don't multitask. Can you guys hear me okay? Cool. David, my analogies are weird. I know they're horrible. My wife has been making fun of me for 30 years. Novak men tend to have horrible analogies. So when you click to order, you get pop-up to confirm. What does that mean? When you push the buy button, it makes you confirm? All right, so let's go to the settings, right? Buy sell button, instant orders placement. Wayne, I bet you that one's not checked. Instant orders placement. So let's see, if I uncheck it and I try to buy, it goes over here and it makes me go through all the nonsense. And it does it for closing the position. I think we just figured it out. So instant order placement, apply to all. There you go. That should fix you, Wayne. You're welcome. I love this. These are the things that I need to learn, right? These are the things that I need to learn. When John gets his platform done, will it look like TV or Ninja? What I have seen of it so far, Jerry, is it looks more like Ninja. It's a little more like Ninja. A lot of similarities in there. We'll know when it's done, though. And then Andy, you were setting your targets at 600 and 1200 this AM. Your stop losses you were able to put at plus 180 really quick. There's really no risk. It feels that way, doesn't it? It does feel like that. Yeah, it's definitely a win, Jerry. But he's anticipating that it's going to look like Ninja. From what I've seen a couple pictures of the programming as it goes through, and it looks a lot like Ninja because that's what you guys are comfortable with. The goal is that we get it. Elvis, I know you're not a techie, brother. So that's why there are instructions. And to be honest with you, Elvis, I would say get with Jason. Let Jason walk you through it. Because you're not techie, put in an order with Jason and say, Jason, I need help getting TradingView set up. And let him do it. Instead of me trying to show you the instructions and us floundering back and forth between the two, you know Jason will take great care of you. There are instructions. They are on the page. And it's literally everything. I mean, it's everything. So there's your answer, but I would say you'll probably do better with Jason. Not until it's perfect, Paul. I know that's a rotten answer, right? Not until it's perfect. That's John Novak's MO on everything. Until it's perfect, he won't. And I don't think they have a date. They almost scrapped the whole thing, to be honest with you. But I think they're back on task. But until they can get everything, until they get everything so that it meets John Novak's standards, it's just too difficult to say. Hell, we thought that the funding company would be live by now and we'd be 5 months into it, but because it wasn't perfect, John Novak hasn't released it yet. Should be soon though. I think he's just about where he wants to be with it. Paul, TV's being used by 60 million users. Absolutely, it will be. Guys, I want you to remember. So there's Nexgen Pro Trader funding. Nexgen Pro Trader funding is trying to get every successful trader in the world to come fund and trade for us. Nexgen Software Services is a software company giving you guys the tools to go find that success. So they're very different. So what I want to do, and of course what Nexgen wants to do, Paul, is we want to expand outside of just you guys in our database. We want to have something accessible and available to every trader in the world. And there's 60 million users on TradingView. So absolutely. And because one of the things that we want to do as well is if you have a plan, awesome. Come use the funding company with our plan. If you don't have a plan, well, then we want to make it so that we can give you a plan. And that's where TradingView is coming in. If you're brand new and you have TradingView and you've never heard of Nexgen and you're looking for a funding company and you find us, man, I'll give you a plan. I'll give you, we'll get you the indicators. We'll teach you how to read them. We'll give you a solid roadmap to follow so that you can find your success and hopefully start making money with our money. So TradingView's not going anywhere in regards to the funding company. Nexgen Software Services, the software uses NinjaTrader. And where the disconnect comes in is you can't use NinjaTrader yet to take part in our funding company. So we're trying to make it accessible to you guys that are comfortable with TradingView or that are comfortable with NinjaTrader. We're trying to give you an option so that you can see indicators that you're not scared of and a very simple plan that sounds very familiar. I don't know better, Dad. I'm not even going to pretend to try to answer questions about a platform that doesn't exist yet. Um, because then I say something, and there's people that'll be like, oh, but Mark said, and then my brother will have to tell you that Mark was talking out of his ass and shouldn't have been saying anything. So we're just going to omit that part of it. I hope so. How's that? I hope so. I really do hope so, but I don't know. I don't know for sure yet. Paul, did that answer your question? That was pretty long-winded. What is John's platform for if TV is being used? It's similar to TV in usage, but it's John Novak's platform. It'll come preloaded for people. We're still a software business, right? So, Paul, if I can give you next-gen indicators, and let me show you exactly what I'm talking about. If I can give you a platform that is a next-gen platform with next-gen indicators with 27 years of knowledge behind it, and it looks exactly like what Nexgen has been teaching for 20 years. That's awesome. That's awesome for the software business, right? Preloaded, and you're like, well, I'm using TradingView. And I'm like, yeah, but I've got a platform that performs just as well. You can use it on the beach, on your iPad. You can use it on a Mac. You can use it anywhere. It has almost none of the draw. It's got the indicators. There's a live class every morning. So just because TradingView exists doesn't mean the rest of the world shouldn't make a browser-based version. And if you know John Novak's going to make the best damn browser-based version that he can. TradingView is a way for us to access the world with the funding company. I'm going through these classes because I love you guys and I know that you're comfortable with NinjaTrader. And I'd love for you to come to the funding company. I'd love for you to trade John's money to make money and to pass those evaluations, but you can't do it on NinjaTrader. So we're creating an option for next-gen users. And we're putting a lot of resources and time in it to make it easy for you guys. No, Paul, it's so TradingView, my camera's on a different counter. So I can get this, the same as John's. I can get it in a browser. I can get it in the app that pops up. I can take this, I can run it on my phone. I can run it on an iPad. I can run it on a laptop. I can run it on any of that stuff. So John's will be just like this. You can run it anywhere. Because now, Paul, you can't run next-gen software if you're a Mac user. So his platform is going to open that avenue up for Mac users. It's like when Lamborghini started making SUVs. Why? Because the guys that wanted the two-seater fast cars can't get it out of them anymore, but they still want to drive a Lamborghini. So now there's an option for us old farts that can't get into it. Does that make sense? John's platform won't be, it'll have the functionality of TradingView. It won't be TradingView, but it'll look like what you're used to. But instead of hitting load the workspace and it takes 3 to 4 minutes on your computer, I want you to see this. The goal, let me close my TradingView. When I open TradingView, that's how long it takes to open. And because I just did that, I don't have my HVAs. So Steve, let's go through the rules. 15-minute reaches an area. Small triggers rolled. Your high volume area line would be right here at 0450. That would fit the rules. Small triggers have rolled off of a zone. There we go. So I'm going to say yes. I like that better, Dad. Simplicity pays dividends, right? Get really good at something. Um, and it's pretty amazing how it translates. You guys ever watched a tennis player play ping pong? They're pretty good right out of the gate. Elvis, go through what? The platform will look like NinjaTrader. You'll be able to run it anywhere. It's a pipe dream. It's non-existent. It doesn't exist. I don't have any information on it. It's designed to run. Well, there is none. I don't have an HVA line. There's the plan. Hold on. First scenario is reached on the large chart. Once that area is reached, the small triggers need to roll. You will sell an HVA line. So if we go to what the live market was showing us, area was reached on the large chart, triggers rolled, you never got the HVA line. So there was no trade. You had 2/3 of the setup. HVA will only be on the small chart, Elvis. You're only running market flow on the 1-minute chart. Paul, you keep asking me about this platform that's not released yet. Man, I just don't have answers. I just don't have answers yet, I'm afraid. I wish I did. When it's done, it'll be done. If I had to guess, Paul, you've already paid for indicators. You've already paid for Nexgen software. You won't have to repay for indicators. I don't know about whether or not there'll be a fee for you to use the platform. I imagine there will be. Just because he's got probably $1 million of his own dollars invested into creating it. My guess is that he's going to want to recoup that. The same way he gave you guys that own software all the indicators for TradingView, but he can't give you TradingView for free because you're Nexgen clients. That's a different entity. So that's my guess. No, it's okay. You can ask him. I feel bad that I don't always have the answers because it doesn't exist yet. It's like hoping the cake tastes good before it comes out of the oven. Once it comes out of the oven, we'll have a better idea for sure. Good stuff. All right, guys, I'm going to hit stop on YouTube. And I'm going to give